We are unbelievably excited to share. I think this is probably going to be like maybe our most popular talk of the year. People always, there's a ton of replay views on like State of the Market and stuff, but we're going to talk about commercial lending tonight. I think that's one of the things that probably holds people back the most in growing their real estate portfolio. And it's one of those common questions that we get. So we're going to do an incredibly deep dive on commercial lending this evening.
Yeah, our goal for this time together is that you understand the problem that commercial lending solves, that this is a solution for the problem, that you understand how to get through the pain, that you understand why this is a critical part of scaling a real estate portfolio, and most importantly, that you have a very tangible action plan to go out and get some lending yourself, because that's how you scale. So very excited to speak about this tonight. Let's dive in. A couple of announcements to share. So just so excited, elated to share. I wish Rachel was here, but again, she's traveling at a conference, but elated to share that Black Swan Real Estate Fund 2 filled down to the wire. We were literally getting wire transfers the last couple of days of the year. Nothing like a deadline to get people motivated and get it full. Yeah. But just really excited about that. A rather large fund, a $30 million fund. We filled that. So excited about the assets that are already in the fund, the projects that we're working on to deploy the rest of that capital. So very excited about that. We are working as quickly as we can, as diligently as we can, to get all of our books together, to get those to the accountants so that our tax forms can be created. At this time, we are on target to get our K-1s out on time, which is on or before March 15th. For investors who are in any of our given funds or joint ventures, you'll get specific communication about that. If you have any questions, let me know. But otherwise, it'll be kind of crickets until kind of early March. I'll send out information about how you'll access your K-1s and then when they're actually sent out. We already have a wait list for Fund 3. I want to be really clear that we don't have any particular plans for Fund 3 at this time. Really, our number one goal right now is to wisely spend the capital in Fund 2 to get those value add plans into place and to stabilize everything there. But people are already asking about Fund 3. So we created a wait list for that, blackswanfund3.com. It will look quite familiar to any of you that have been on the wait list for Fund 1 or Fund 2. So if you'd like, you can go and put your name on that so that you know when that's available. And then 2 of our upcoming webinars are our Q4 updates for all of our funds is February 7th at noon Central. A replay, of course, will go out, and then also like a written brochure of our updates for Q4. And then our February community hour is February 15th at 7:30 p.m. Central. So those are all of our updates. I put those at the beginning because we sometimes go very long, and I want to make sure that people get those even if they have to head off to bed.
I get the feeling it could be a long night tonight. We'll see how many questions we get. There are a couple notes there about audio quality. Can people hear us okay? Or some people said it was clear, other people said it was not. It seems like we're maybe doing okay there. Okay, we're gonna keep moving then.
Okay, yeah, definitely like put chat in if if that's helpful. We want to make sure everything is working really well for everyone else. Awesome. All right, a little bit about us.
Yeah, so we are Nick and Elaine Stoggenberg. We're the owners and operators of Black Swan Real Estate, Black Swan Living Property Management. We're a real estate private equity firm, property management company, vertically integrated. We have over $1/3 billion, or about $1/3 billion in total assets under management. And we love to make the world a better place to live in the most tangible sense of the word. Trying to bend the moral arc of capitalism towards justice in some small ways. A lot of kind of unique things that we do. We just try to take really good care of our residents, and we think if you do that, everything else will take care of itself. We have a profit share for our team and a give back, a charity component to our private equity fund, trying to change the private equity fund space. We're already starting to see some of those changes in some really exciting ways. There's no fees whatsoever to our private equity funds, no pref or catch-up pref or waterfall or split. So just some really cool things that we do there. We've raised about 50 million here in the last 18 months or so, approximately. So it's been a pretty good year there. I'm not aware of many people that aren't, an institution like Blackstone or something like that that's raised that much capital. Elaine gets all the credit there. So joke is Elaine raises the money and I spend the money. So I know how unbelievably hard you've worked on that capital raise here in the last.
It's been a pleasure.
Yeah, absolutely. And just an amazing team there. I get to play around in the dirt a little bit, doing some ground up construction. Just started working on a 180-acre deal today for some land development, but right now,
Excited for you.
yeah, thank you. We've got a fun couple of projects. Spent an hour today with an architect. Yeah, just lots of fun stuff happening there. Brainstorming names for. So if you had a subdivision of 1,000 luxury townhomes that was like Swan themed, like
Or dog themed,
Shepherd or German Shepherd or whatever, what would you name it? So feel free to put that in chat.
Like, for real, put it in chat. We'll do like a vote. We'll do all sorts of stuff about it. So we have named a couple of streets, the streets that we acquired Stonehaven, and that already had a name, but the streets were like 7th Street and 8th Street. And we're like, no, that's not acceptable. So we named our streets Cairn, which is, like a set of rocks out in the wilderness.
Wayfind, yeah.
Palisade and Monument.
Mhm.
And that was a ton of fun to look for words that have like a good vibe that are related to stone, which was surprisingly hard. But when I see those street names now in our property management software, I feel like they're good names. But naming a subdivision is an even bigger task. So help us with naming that.
We actually just acquired an adjacent parcel there at Stonehaven. So with any luck, it'll go from a $45 million project to a $60 million project here in the next 6 months or so. So we're really excited about that. And we do a little bit of real estate sales as well. We're in the top 1/3 of 1% of all real estate sales teams at Keller Williams, which is the largest real estate organization on earth. So we love to.
And then I have to tell a funny story.
And like half of our team is getting a license right now. So we have a lot of real estate sales
really
this year.
Excited about that. We just did a 5-day, very intensive, immersive business seminar where you do goal setting for your business. Super excited about the things that came out of that. And one of the goals that many of the people on our team had is to get a real estate license, to do their own real estate investing. So super excited about that. What meeting was it that we were like a third of the way through the meeting, and the person we were meeting with was like, "Are you two married?" Do you remember that?
I remember that. I don't remember the meeting.
It was like a month ago or something, but we're also married to each other.
Yeah. Yes.
All right.
We get to be married. So why are we here?
So we're talking about commercial lending. And I find that when people are thinking about financial freedom, thinking about real estate investing, they kind of put a number in their head, 20 doors, 50 doors, 100 doors, whatever that number is. And they're very focused on the deal. They're focused on finding a market, finding a team, actually acquiring properties. And the first couple usually go really well. There's a steep learning curve there in terms of the actual putting together the actual deal, but the debt tends to be pretty easy, especially for kind of most people who are on this call that are likely high income, dual income families, high net worth, able to get conventional loans rather easily. And then around, I would say 5 to 9 is a common number that I see, really depending on how much someone's income is, how much other debt they have, if they're married, if their spouse has an income. They reach this point where all of a sudden they run out of the ability to get conventional loans. So by the book, a person can have 10 conventional loans, and a married couple, if they have their conventional loans separate, can theoretically have up to 20 conventional loans. I personally have never met a married couple that actually got 20 conventional loans, but that is theoretically possible. What I typically see is around 5 or 9 properties, all of a sudden they can't get a conventional loan, and either they've never heard of commercial lending or they have heard of it and they're just terrified. It's just this whole new world. They feel super demoralized. If I just learned real estate investing, I was just starting to get kind of my feet under me, really understand this, really know what deals I'm going after, understand the numbers, maybe have a relationship with a general contractor, property management, kind of all of those pieces, and they just stop dead in their tracks. And I love this picture here from intentionalexcellence.com that kind of walks you through this pain, this valley of despair. You can see things are getting worse. I love the emojis there. And it just stops people. And they, at that point, maybe they're cash flowing, say $300 per door or even $200 per door over the last several years as the market has tightened. Maybe they have 6 properties, so they're at, I don't know, $1,500 a month in cash flow, but they don't know how to keep going. And they say, like, this isn't going to get me financial freedom. This isn't going to get me out of my job. I don't know what to do. Why did I ever start this in the first place? and we'll get an email or a phone call of, seems like you guys have a lot of single family homes, or you guys have a lot of real estate. How did you do it?
Yeah.
And that's where that acceptance, that openness, testing, relearning, and integration, getting to a place where commercial lending is not only accepted, it's exciting, because commercial lending is actually way easier than conventional lending. Once it's mastered, it's way more powerful. And so we want to get people through that valley of despair, prepare people for it before they ever get there, so that they know that this is coming. They can start making relationships. They can start getting their mindset right about it, connecting with people, or if they're in it, they can see a path out, and just sharing, a really special part of our journey as we had to get through this ourselves too. We have a fun thing to share tonight. Our credibility deck. We're going to talk about what a credibility deck is, and we're going to share one of our original credibility decks that we used to get like what I would consider to be like our first large piece of commercial lending.
Yeah, one thing I'll mention is that one of the most challenging things for people in this cycle is that most people, when they go to get a loan on an investment property, they'll often reach out to the loan originator that gave them a loan on their personal home. Like, hey, it went really well. And yeah, that person can sell you a loan on an investment property. And that second one, you usually get really great terms. Maybe it's a vacation rental and you get a 5 or 10% down loan, or something like that. And then it seems like it just keeps getting worse and it keeps getting harder. And they're not quite sure why. And then eventually that loan originator that you've been working with, that you've trusted, that's gotten you to the closing table time and time again, they just say, I'm sorry, but you can't get any more loans. And they don't tell you that there's other places to get loans, because, they don't really want to like send your business somewhere else. But
or they may not know themselves.
Yeah, they may not know. Yeah, they may not know.
Yeah, there's such separate parts of the bank.
Yeah, they might work at a bank. Their office might be next door to a commercial lender, but those two, their paths never cross. So a lot of times when people, talk to us on the phone, they're like, what do I do? My banker just told me that I can't get any more loans, but I only have 5 properties and I need to have 50 to get to financial freedom. And they just don't know about commercial lending.
So one of the things that we talk about whenever we're experiencing any type of like emotional pain, or we're struggling with a decision or anything in our personal life, business life, is we have learned that the breakthrough always comes after the breakdown. That's just how human psychology works. It's how growth works. So at first we're in our comfort zone, then there's tension. You can think of like that learning curve is getting steeper, it's getting harder. And then there's a breaking point. And that's often, unfortunately, the part where people stop, particularly with commercial lending. They throw up their hands and they say, I just spent so much time learning how to do real estate investing. If I have to learn all about commercial lending as well, I'm just going to quit. And that's really like the worst time to quit, because it's right before the breakthrough, where someone can couple their real estate deal knowledge with their real estate debt knowledge and really have powerful outcomes. So that's the breakthrough that happens after that, and then that up-leveled state. And I love that this is like inception. So one of the things that we talk about is real estate is really just an opportunity to practice these mindset things in real life, because there's such big decisions that are being made in real estate all of the time. There's very few small, minor decisions to be made in real estate investing. And the breakdown always precedes the breakthrough. And if you train yourself to love the breakdown, then you're like, oh, I'm having a breakdown. There's a breakthrough coming. I wonder what that
Celebrate it.
Yeah, celebrate it.
Yeah.
And our goal for tonight is to teach you about the breakdown. If you're already in it, give you some help, show you ways through, give you a concrete, tangible plan that you can start implementing tomorrow, so that you can master commercial lending and use it to scale your portfolio.
Absolutely.
And then it goes without saying, if you have any questions, just start putting those in chat.
Yeah, please.
If we're able to answer them kind of as we go through,
Yep.
we always do that. If not, we hold them till the end, but we'll make sure that all of the questions are answered tonight.
So we talked about, the pain points, or the single most common pain point, probably tactical item that people encounter as they're, growing their real estate portfolio. So let's kind of flip that around, and maybe you're not in that pain point, or that pain point doesn't make sense to you. Let's share just a real life data point that we encountered here in the last 7 days. So Elaine and I are going to do a series of brief role plays here as we're going through. Do you want to try to role play a conversation with our lender that we just had?
Absolutely.
Okay, so you'd be the lender in this case. So 15 minutes is actually an exaggeration. I'm gonna give you a slightly abridged phone call, but not that abridged. So
how about IBU? Because I don't know what the lender said.
they just said yes, basically.
I mean, I'll be you.
Okay.
Okay. So Elaine, I'm going to call so-and-so over at the bank because we need more debt on our next round of townhomes. I just got that land under contract. Ring, 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 ring.
Hey, this is a really big, powerful banker on his personal cell number. How is this going? Or hey, Nick, how's it going?
I'm doing well. How are you doing today?
I'm doing fantastic. I was just skiing down in Arizona and hanging out with my friends. Those people I took you out to dinner with in Minneapolis a month ago.
They
I was just hanging out with them.
they
Yeah.
they were so nice. Elaine and I
Yeah.
had a really nice time at dinner. Thank you again for inviting us.
Oh, it was my pleasure. We love just spending time together. Yeah, I'm sorry, your time you're in high demand. What can I do for you, Nick?
Yeah. So, our subdivision over in Byron, we're working on those
Yeah.
townhomes. So, you guys have the lending on the second phase there.
Yep.
And you wouldn't believe it, but I've been working on that land across the street for a while. You know the land I'm talking about?
Yeah. I think you mentioned that a while back.
Yeah. So I think I have a deal put together there.
Wow, awesome. Congratulations.
Thank you. I mean, I'm excited about it. But I need to have, I need to have lending in place.
Yeah,
And I really need to have those numbers so that I can, really sharpen my pencil, make sure I know, exactly what the profitability will be, if it makes
course, yeah.
sense. So I have a bid out to our builder. I should have that in the next couple of days. And of course, with you having the debt on that second piece of Stonehaven, it just made sense for me to give you a call. So what do you think about that?
I think that deal's working out pretty good for the bank. We could probably put together the exact same deal we put together last time. Rates are probably up maybe 3/4 of a point. I mean, for you guys, we could just maybe call it a quarter point. I could
Okay.
probably get that through. So numbers would be pretty much the same as last time, right?
Yeah, pretty much. Some, lumber has gone down, but some other things have gone up. But like on the whole, it's a wash. Rents will be about the same. And my hope might be we're pushing dirt while we have, phase two going. We'll kind of run them in tandem.
wow.
So yeah, I want to get this done, as quickly as possible. Really, I don't want the bulldozers to drive away,
Okay. So if it's okay with you, then what I'll do is I'll just take all the numbers from the last deal we put together
That sounds great.
and I'll just give that to the board, and I bet they give that a green light. Does that sound good, Nick?
I love it.
Okay, sounds good. Talk to you later.
Thank you. I never had heard that conversation, so I'm glad I
Yeah.
got to hear it.
Yeah. And that's it. Like, I mean, this may sound ludicrous. This may sound like an exaggeration, but that was literally the conversation. Just a little bit of just personal relationship. And hey, we did a good deal together before. Like, would you like to do it again? And I have done no additional work on that. The banker is working on getting the underwriting, through right now, and he'll have a bunch of steps through his process, which we're going to run through here in our time together tonight. It's not easy to get $15 million in debt. A lot of people would spend, 100 hours of their time talking to a lot of different people and trying to reach out to national firms and talking to loan brokers and stuff. But when you really aggressively work to just build genuine relationships and feed those relationships with bankers, you can go back to that well over and over and over again. This is a relationship-based game. People treat it as like kind of a transactional business, and that's so short-sighted. We've called bankers and they'll say, gosh, we've lent so much money to you, we're actually legally not allowed to lend you more money. Or, we just wrote a big loan to someone else, so our bank is kind of overcommitted multifamily. But, I really hate to turn you away. If it's all right with you, I'm going to call like half a dozen bankers and see who can get you the best deal right now, just to make sure that you're taken care of. Are you okay with that? Like they will go to the ends of the earth to try to make sure that we're served, because they too value that relationship. So I hope that is that carrot is a little exciting to you, because it's very exciting to us. We've worked hard for many years to build these relationships, and then we get to see these relationships pay dividends over and over and over again, like in this circumstance.
So let me share a tale of two cities, a tale of two investors. So these are real people. Two of them might even be on this call, I don't know, that have emailed me in the last, say, 2 weeks. These are real stories. I was actually thinking about cutting and pasting the emails and just kind of, deleting the things to make it more anonymous, but decided that this was the best way to preserve their privacy. But these are real stories of real people. So investor one is a high income, high net worth physician. He or she recently acquired a short-term rental at a little under $1.5 million, acquired it with cash, to give you some perspective of that person's financial situation, has no experience with commercial lending, but is an experienced real estate investor, is looking for a cash out refi, doesn't currently have any commercial lending relationships, and sent me a nicely detailed email saying, Elaine, I've gone to 4 banks in my local area. 2 of them were credit unions, 2 of them were banks. And these are the responses. The responses are, we don't know how to lend to LLCs. We don't have commercial products. We don't do lending that large, and we don't know who to connect you to in the bank. So this investor that emailed me was just really confused. Like, why is this happening? Pounding the pavement, really putting in the time and effort to break through on those commercial lending relationships. My advice to this person was, this is very normal.
Yes.
You are not crazy. You're not losing your mind. You're not doing anything wrong. This is completely normal. I gave her some tidbits on strategy of specific words to use, specific like job titles to ask for. Not all credit unions don't do commercial lending, but many of them don't. Credit unions are really focused on providing financial services for households. So I said, try banks instead of credit unions, but spending a lot of time on this. Investor 2 is also a high income, high net worth physician. This person wants to acquire a medium-sized portfolio, really thinking about 50 doors in the next year or so, is an experienced real estate investor, but also has no experience with commercial lending, looking for financing in advance, and one email to a commercial lender via a warm referral was everything that this person needed to be approved in $2 million in lending with just a few emails. So enough to acquire probably about 20 houses, maybe 18 or so, kind of depending on cost and closing costs and those sorts of things, but a substantial way to this person's goal. All of that has gone through my inbox in the last couple of weeks.
Yeah.
And so our goal for tonight is to show you that investor 2 obviously has, a substantial head start. So that's really why we hone on invest in your local area, invest in your backyard, invest in communities where you have an unfair advantage, where you have relationships with people. It's a big part of the reason that we are only in Tacoma, Washington and Rochester, Minnesota, because we're big believers in being deeply invested in a market, knowing all of the players, having those relationships. And then investor 1 is doing the right thing. And this person will have success just continuing the process. And once the first breakthrough happens with a commercial lender, then just like Nick said, once you're in the commercial lending world, it's very easy to navigate. It's very easy to continue to build the relationships, but it takes work in the beginning. And so our goal tonight is to show you how to speed up that process and to give you, very tangible things that you can do.
Rebecca said we had good role playing. I'm gonna.
We held our
celebrate
phones
that.
really far away. We're like germaphobes or something.
This isn't even. You got to do this. This is the role play, not this.
The phone.
I'm 39. I'm about to turn 40, so my age is showing here.
Yeah. Jennifer asked a great question that I think really goes well right now. So what banks or bankers do you choose to start building relationships? It's going to be different for everyone on this call, because everyone on this call lives in a different city, invests in a different city. So if someone's interested in Rochester, Minnesota, I can give you a list of 15 or 20 banks. I can do email referrals, very close relationship with those folks. But if it's a different market, I don't know. I tell people, when you're driving to the clinic or taking your kid to school or driving to church, whatever it is, have your eyes peeled for banks. And those are the banks that you need to reach out to.
Absolutely. And we're going to have a whole slide to really dig into that here in detail later in the show tonight.
So the deal plus the debt is magic. Just remember that. Debt makes the deal, particularly on large deals. A swing of even 1 percentage point can totally change the deal. We're seeing that now as a lot of deals are facing struggles with variable rate debt. For every hour you spend learning about real estate on the deal side, you need to spend an hour learning about real estate on the debt side. I find that it's a piece that people just don't talk about as much. So hopefully this is useful information for you tonight. And then mastering the commercial lending process is the number one thing, number one thing that holds back most investors with a small portfolio. This is the breakdown. We're going to show you how to get the breakthrough.
Yep. And we live this. So I spend a crazy amount of my time just meeting with bankers, just having conversations with bankers, just bankers taking me out to lunch, asking what we're seeing in the market. Sometimes Elaine sits through those meetings as well, but it's a big time commitment, so it's not valuable for us to both necessarily be there. And it's always a fruitful conversation, never necessarily the way I expect, but maybe they can bring us a deal. Maybe they are excited to do a refi. Maybe they're shopping for a referral and I have a referral that I can provide them with. Maybe these people frequently sit on zoning and planning boards and they know about deals. I'm like, hey, Nick, have you heard that thing's for sale over there? No, I hadn't heard that. How'd you hear about that? And it can be incredibly powerful to meet with these people who are in the business.
Absolutely. Let's do a little bit of terminology.
Yes.
So we're going to go to like commercial lending 101. So this is the time to take notes, paper notes, type notes, whatever it is. So there are different types of debt. It's important to know the words so that you understand when that type of debt is used and you understand exactly what type of debt to ask for. So the first type of debt is conventional debt. That's what most people think of when they think of a mortgage. Anyone that's in their personal home almost certainly has a conventional mortgage on the home that you live in. If you have a second home, it likely has a conventional mortgage. If you have a small portfolio of rental properties, it's likely that those are conventional loans. So this is what we think of. A conventional loan is what you need to think of with like a 30-year fixed mortgage or a 15-year fixed mortgage. And some of the servicers of conventional loans are banks themselves, FHA, VA, and USDA. So when you think about like an owner occupant or a small real estate investor owning property, they tend to own that property with a conventional mortgage.
99% of single family homes in the United States that are owner occupied have conventional loans. Probably 80% of vacation homes that are kind of owner purchase, are not pure investment, have conventional loans. So this is a thing that everyone's very familiar with, and this will be kind of our baseline for comparison to these other debt types. Anything where the bank keeps that loan on their books is called a portfolio loan. So commercial lending is actually a type of portfolio loan because those commercial loans are not typically resold to a secondary market. Whereas with a conventional loan, the bank may originate the loan. It might be, Wells Fargo or your local regional bank that originates that loan, but they don't keep that loan on their books. They might even service the loan, but they will resell, they'll securitize and package that and sell it as a security on the secondary market. Whereas with these portfolio loans, they keep those loans on the books. So the way they underwrite those loans, the way they think about those loans, and the way those loans are regulated are very different. So a HELOC is going to be the most common type of portfolio loan that you have likely interfaced with. That's a portfolio loan. There's no such thing as like a conventional HELOC. So when you go just call a bank and say, hey, I'd like a HELOC, 99% of the time, they're going to keep that loan on the books. There's tons of other types of portfolio debt. So if you needed like a business line of credit, a commercial line of credit, some sort of cash management product, all these things are all different types of portfolio debt that bank ultimately keeps on their books. Then there's commercial debt.
There's also a misconception that someone cannot get a HELOC on a investment property. That's just completely not true. You just have to work with a commercial lender that understands that that's the type of debt instrument that you want, and understands why you want that. It's usually so that you can have liquidity available, but not pay interest when you're not using the liquidity. So it's very possible for someone to have a HELOC on an investment property.
Yeah, that's a strategy we leverage extensively. There's a huge swath of properties that we don't have a mortgage, an amortizing mortgage on. We have a line of credit because there's huge amounts of cash, of liquidity that's kind of coming and going all the time, and we don't want to be paying interest if we don't have to on that debt. Then there's commercial, and we're going to really dig into commercial here in just a moment. And then there's institutional debt. So maybe you've heard other syndications getting Fannie or Freddie debt or HUD debt. So these are going to be large loan instruments. So minimum 1 million, but really like 5 million in loan size for most of these loan instruments. If you have $100 million loan, it's typically an institutional loan. At that point, it's typically larger than what you'd get from a regional bank. So regional banks can absolutely do a $100 million loan. And people will, I would say, brag about using those institutional debt instruments, feel very sophisticated, or feel like they're getting incredible loan terms. And you can get very good loan terms, though really what it is it's just a convenient way to get non-recourse debt. If you don't want to put your personal balance sheet on the line, it's a very convenient way to get non-recourse debt. But those loan instruments, I would say, universally, you get a worse term sheet than you might get from a regional bank if you're willing to put in the hard work to find really high quality regional bank debt.
We had a question: is it possible to have multiple HELOCs on a mix of personal and investment properties? Absolutely. That's Amy's husband, Mike, that asked that question. Absolutely. So, and it can even be, different banks, and someone can even have a conventional or commercial mortgage on a piece of investment property and then also have a HELOC on top of that. A HELOC is like a Lego piece that, I would say banks are less comfortable with them, but it's certainly possible. And what we have found with our portfolio is across all of our lending, I think we've found, 3 banks that we have all of our
Yeah,
HELOCs with.
pretty much.
So like those banks were comfortable with HELOCs, and then we just said, here's all the homes that we would like HELOCs on. And they
Yep.
said, that sounds good.
Yep.
But just to say that it is possible, but most banks, either don't understand it or they say it's just for a personal loan or personal home, but very possible to have a mix of many HELOCs on various properties.
A critical takeaway you need to have from all this is that everything in commercial lending, any kind of portfolio loan product, is 100% negotiable.
Mhm.
So in the conventional world, it's like going to Costco. Like there's no haggling, there's no relationship. Like here's the thing: if you go to one Costco, it's probably pretty much the same thing at every other Costco. If you get one conventional loan, it's going to be very similar. There might be small differences in price or customer service quality or whatever that's regional or varies based on that specific loan originator. But it's basically the same product. Whereas with commercial lending, it is a bespoke product, and we're going to give you a lot of common themes that you might see. But at the end of the day, it's all what you can negotiate, what you can sell, what you are able to work with the bank to achieve. So we just achieved a full cash out refi on New 52, and we did that via a third lien position on that asset. I've never even heard of that, but we went to the bank and just said, hey, you've already got 2 lien positions on this asset, and one's at 3.25%, and we really don't want to do a refi to give up that 3.25%. Another one's at like 4.5 from the cash out refi we did before. Would you like to do a third lien position? And the banker was like, well, I don't see why not. It doesn't, I've never heard of that before, but I don't see why the board would reject it or why we couldn't draw up the paperwork. And there was zero pushback or negotiation. We merely had to ask. But if we hadn't asked, we never would have gotten it.
Mhm.
So that's the cool thing about commercial lending is you can be very creative. There's limitless creativity.
Absolutely. So let's talk about term. So the term is how long that debt exists for. And typically the term matches the amortization in conventional lending. So that's often why people won't understand term in commercial lending, because term and amortization often don't match in commercial lending. So a conventional loan is typically a 30-year term, 30-year amortization. So that means that every payment for 30 years, the payment is the same. And then at the end, there might be, one trailing payment for that last little bit of principal, but everything is lockstep. And we're talking here only about principal and interest. Obviously, taxes and insurance is different. But for principal and interest, it's lockstep for 30 years. Commercial lending, the term is different from the amortization. Most often, commercial lending is a 3 to 10-year term. It's usually like 3, 5, 7, 10. Again, all of this can be negotiated. If for some reason you knew that you wanted your term to be 8 years because something was happening in your life at that time, it's likely that a commercial lender, could make that happen. Shorter terms are riskier, longer terms are less risky. And that's just because it's harder to predict the volatility that might happen in the market in a shorter term. Like people who got debt in, say, December of 2019, no one knew that a pandemic was coming just a few months later. Turns out that pandemic was really good for real estate, but in the event that the pandemic had not been good for real estate, we're only just now really getting back to normal after the pandemic. And even then, lots of things have shifted. So that 3-year window is riskier, whereas 10 years is a lot of time to hit a good point in the market cycle, to figure out a business plan for the value of the asset to grow, for cash flow to grow. So longer term is safer. The most common term is 5 years.
So really, really quick, why is that 30-year term desirable for a conventional loan? 30-year fixed. Why is that such a great product that really has made American home ownership kind of the envy of the world? Feel free to throw your thoughts in the chat if anyone wants to speak up. Why is that such a good product? Interest is deductible, but I'm really focusing in on the term. Why is it good to have a loan that runs for 30 years in a personal home and a fixed rate? That's right. So for your personal home, why is that a good thing? Predictable payments. That's exactly right. So I can lock in a loan and cost of living might go up. There could be huge inflation, but my housing payment stays the same. So there's massive stability for a U.S. homeowner with that loan. Now let's flip that. Why is a 30-year fixed loan kind of a terrible idea for a investment property? Oh, Mark said paid off in retirement. That's another good point, is that amortization, that term. after about 30 years, you're retired, and all of a sudden your cost of living dips down
Mhm.
significantly. So that's a
Mhm.
great point, Mark. But okay, so why is a 30-year term such a terrible idea for a commercial loan? You aren't going to keep the debt that long. That's exactly right. So after, probably 5 years or so, the average is 5 to 6 years, you're probably going to sell that property or refinance. And so by getting a 30-year fixed, you pay a premium to fix
Mhm.
a rate for 30 years,
Mhm.
and that reduces your rate of return. So commercial lenders, depending on your business plan, they're going to ask you a lot about your business plan. It makes no sense to do a 30-year fixed loan for 99% of real estate investors.
Very good. Next is rate. So we're kind of hitting on that a little bit. So the typical rate for a conventional mortgage is 30-year fixed. Of course, there are adjustable rate mortgages, but those tend to be somewhat rare. And then for commercial loans, it's completely different.
Mhm.
So for all of the stability and simplicity of understanding rate in conventional lending, commercial lending is totally different. Variable, fixed for the term, fixed for a portion of the term. It might be, say, a 5-year term with a fixed interest rate for 3 years, and then a reprice to get to that total of 5. Variable and then fixed after that. I mean, just on and on. Anything that you can imagine as ways that the rate can change, that can happen, because it's not a conventional mortgage, which is all the same paperwork over and over and over. There might be one blank for what is the rate of this mortgage. A commercial loan is the promissory note is drafted by an attorney. So the attorney can just type in anything that the bank and the borrower have agreed upon.
Yep.
with as many changes
Yep.
and personalization and everything as possible.
So why would someone want to get, just as to pick an example here, a loan that would be fixed for a portion of the term? So the most common loan that we get would be a 25-year amortization. So, or I'm sorry, a 10-year term. Going back to the first slide there, a 10-year term, and it's fixed for 5 years, and then the price resets at 5 years for another 5 years. So why would that be a desirable loan instrument for us to get? And that's something that we specifically request. That's not really ever something the bank offers. That's right. We would typically refinance before the end of the 5 years. So that 5 years gives us a lot of stability for that first 5-year period. Why would we ask for that second 5-year period? That's right. So now you have a fallback plan. If there's a major market change, you get to hedge your bet. How much?
And you can also write your pro formas today with the worst debt that you'll have in 5 years.
Yep.
And know if rents don't change, if nothing else changes, which typically doesn't happen. Typically rents go up, but even if rents don't go up at all in 5 years, can I service this higher debt?
Yep. So it would be probably pretty insane for us to negotiate a loan where we parlay that term out, 20 years. Like, you don't need a fallback plan for that long. And if we were to try to get a 10-year fixed loan, that would be very expensive. The bank doesn't like that interest rate risk, but giving the bank kind of an out to reprice the loan, but they aren't allowed to call our note due. In general, the bank doesn't charge us anything at all for that. In fact, we say, isn't it a win-win that we now have additional security in the note? And we've never had a bank, agree to extend the term in our initial loan origination and have them, really like charge us any premium whatsoever for it. So everything is totally negotiable. Another fun one there that we're not going to dig into, but you could make something variable and then fixed in the future. So that's something we could potentially do for our Stonehaven loan. I know that sounds a little bit crazy, but interest rates are pretty high right now. So what we do is we actually start our loan with a variable rate with a high rate, and then the rate can go down because interest rates are probably going to go down over the next couple of years. Early in the life of that loan, we haven't drawn anything yet. We're just pushing dirt around. There's a few $100,000 in draws. Later on in the life of the loan, that's when we're going vertical. We're buying lumber and windows and stuff, and then the building's full. It has tenants and the loans at max draw. And that's when the interest actually kicks in and the interest rate has gone down. And then in fact, you can fix your rate in the future. So if you were to fix your rate today, I'd be fixing it at like 6.5%. But I can talk to a bank today and say, if I fix that loan starting 3 years from now, I can fix it 4.5%, because they've got models that say, well, a couple of years from now, the rates are probably going to be lower. So we'll give you a fixed rate for starting 3 years from now. But in the meantime, you're going to have to ride out that risk, not us. But in the meantime, that's when we don't have, our construction loans completely drawn. Does that make sense how we can sync up kind of the risk profile with our draw pattern on the construction loan, with kind of future predictions of interest rates. Now, the bank would never propose that to us. We have to go to the bank and say, hey, is there any way we could do a loan that's variable for the first, 2-3 years, and then it's fixed after that? And, I guess I've never heard of that, but yeah, why not? Sure, absolutely. Well, what would our rate be starting 3 years from now? 4.5%. Oh, sign me up for that. Absolutely. And now again, we've got a great plan B. Maybe we get 3 years from now and rates are 3.5%. We don't actually have to execute that 4.5%, but we've got that fallback plan in the bank. So again, like, you could do anything with these things. This is the most confusing thing, I think, to a lot of people. You can manipulate your rate and term in commercial lending.
One of the things I want to speak to from a mindset perspective is I remember a time when everything that Nick just said would just make me so angry. I'm like, these bankers are selling us a product. They're getting a commission on this. Like, why aren't they the ones coming up with all these ideas? But we would hear things either from other commercial lenders or from, other people in our masterminds, other real estate investors, and they would say, hey, you should go ask for this thing or try this thing. And when we would ask, our bankers were like, absolutely, I'm so glad you asked. I'm happy to do that. And I would just be so frustrated with that. And I want to speak to that because I bet there's at least a few people that feel like, well, why do I have to be the one that comes up with this? Or I might feel stupid asking for this, or I don't know what to ask for. Ask for anything. Ask for, a proposal, put things together. One of our coaches, really like hammered home, like, you are the leader.
Yes.
It is your job to come up with the ideas, to come up with the plan, to come up with a vision of the future, and then bring people with you. Bring your bankers with you, bring your attorneys with you. They're going to make sure you're in compliance and that you meet all of the, legal and accounting, and the bank's going to make sure that everything's on the up and up. But saying something like, hey, can I do variable first and then fixed, or can I do fixed first and then variable? That's up to you as the leader of the deal to put all of those options out there and see how the bank can meet your needs. So I just wanted to speak to that, because now I hear what you're talking about, and I'm like, oh, I wonder what other idea we can come up with, or thing we can learn from someone else. Or
attending webinars like this are how you become the leader, of how you go to your banker. Maybe your banker has never heard of half of this stuff. Like, the worst they could say is no.
Absolutely. All right, so amortization, we've kind of touched on that as we're explaining things. So in a conventional loan, the amortization almost always matches the term. So if it's a 15-year mortgage, that means it's a 15-year term, 15-year amortization. If it's a 30-year mortgage, that means it's a 30-year term, 30-year amortization, which means the payments are the same all the way through. At the end, usually that last payment is a little bit different, but otherwise all the payments are the same. Commercial lending is completely different. So the term and the amortization are completely unrelated to one another. And as I mentioned earlier, I find that's where people get a little bit confused, because we're just so socialized to believe that term and amortization are the same. So typically amortization in a commercial loan is anywhere from 15 to 30 years. Usually the newer and nicer the property, the longer the amortization might be. The most common amortization is 20 or 25 years.
So far, before we go to the next slide, you might be thinking, commercial loans don't sound that great. They're like a shorter term, they're a shorter amortization. You can do fancy stuff with them, but I don't understand why would I ever want to get a commercial loan instead of a conventional loan? So I hope you're taking notes here, because it's about to get a lot more fun.
Go for it.
Sure. So we originated a $5 million loan last year on one of our apartment building deals. It was 3 apartment buildings that we basically put into a single note. And it included our purchase financing, all of our construction financing, and our total origination charges on that whole deal was about $1,000. So it was like 0.001% origination charges. And that's just a pure cost savings. The origination charges on conventional loans are pretty heavy, because they have to bundle up those loans, securitize them, sell them to the secondary market, and because you're buying a 30-year fix on the rate, which you don't need in an investment property, because you're probably going to refi or sell that property within approximately 5 years or so. That's just how the business works. There are lots of fees associated with getting a conventional loan, and they're really not very negotiable. You can kind of negotiate with them, but not much. So maybe you're paying like $1,000 for an appraisal. I'll see that on a conventional form sometimes. Well, the appraisal only costs $500, and they choose to charge. I mean, they're probably paying $400 or something like that, and then they're just charging you $1,000 to maybe mask some of those fees. Those are all just profit centers for the loan originator, for them themselves, or for their brokerage. Commercial, I'd say a baseline is about 1%. The larger the loan, the smaller that origination charge. It can be almost zero, And then this is pretty hilarious. You can negotiate on everything. So literally you can go line by line on a settlement statement and say, hey, I see you have a $200 documentation fee on this thing. Is there any way you could waive that? And the worst they could say is no. And sometimes they're like, I really disagree with those documentation fees. We'll just strike that one out. Or we will ask to waive appraisal, which saves a ton of money, ton of time, and just makes the deal a lot simpler. We will even ask to waive lender's title insurance, which most people don't even realize that's possible. Because again, you can't negotiate these things on conventional loans. You can't negotiate these things on Fannie, Freddie, big institutional loan instruments either. Your lender's title policy on a big deal. I mean, like we just closed on a $25 million deal. Your lender's title policy could be tens of thousands of dollars, and you just say, hey, the attorney's going to look at the title, and they're going to give a title commitment to say whether or not they would issue title insurance on it. So at this point, I mean, that's called a title opinion. That costs like $100. Not tens of thousands of dollars. And isn't that good enough for you? I mean, have you really ever had the title insurance policy pay out? It's 99% profit for the title company. So it's a mile of inches. When you're getting a $24 million loan, 3 points on that is $750,000. It's a staggering amount of money. And we probably saved millions of dollars in total lender charges last year in our private equity fund.
Absolutely.
And then when you're buying like a single family home or vacation rental or whatever, if you have like $1 million, property, you're paying, $20,000-$30,000 in lender origination charges that you can probably get, waived all the way down to almost zero if you work with a commercial lender.
Let's talk about appraisal. So for conventional loans, almost always requires a third-party appraisal unless the borrower is extremely high income or the loan is very low LTV. So kind of the situation that we've seen is, someone that has, say, a household income of $1 million, that's had that household income for many, many years. It's stable income, is maybe downsizing and buying a home that they will live in for maybe $300,000. Maybe they're buying like a small townhome or something. Well, their credit and their income is so much larger than and maybe they're bringing $100,000 down from their investments or something like that. So their credit and their income is so good, and they're bringing so much capital to the deal that the lender will waive the need for an appraisal. That's pretty rare across all of our real estate, journeys. I think we've seen that maybe 3 or 4 times.
Yeah.
So in general, you should just kind of have in your notes that a conventional mortgage requires a third-party appraisal. Commercial lending, surprise, surprise, completely negotiable.
Totally negotiable.
There can be a full appraisal, which is where the appraiser will want to walk, several units, want to, go into the structure if it's, say, a single family home or a duplex. They're looking at comps, they're looking at replacement value, they're looking at rental rate. They can do a drive-by appraisal. I find that those are a little more common through COVID. A desktop appraisal, which we like the least. It's very fast, which is nice, but we tend to do a lot of renovations. So we want people to be in our properties, seeing those renovations. But that can be a great option if, say, you're getting financing and you're about to do renovations. So you're getting kind of your first batch of financing. And maybe you don't want the appraiser in that property because there's 1980s wallpaper everywhere and orange carpet or whatever. So you're happy with a desktop appraisal, and then you plan to do a cash out refi later after you've completed your renovations. Also, a comparative market analysis, a CMA, a broker price opinion, a BPO. You can think of those as less stringent forms of ways to value properties besides a full-fledged appraisal. An internal bank evaluation is even less stringent, even less sophisticated. It's literally just a team of people at the banks kind of looking at comps themselves, making some assessment of the value of the property. And then in some cases, depending on the relationship with the bank, with the type of lending that you're looking for, with how much debt you want to get against that given piece of property, there may be no appraisal at all. So, if someone has, say, let's say a quad and it's worth, say, $500,000, and for whatever reason it's paid off, maybe they inherited it from their parents or something like that, and they want to get just a small amount of money, maybe $100,000, then the bank may say it's so evident that quad is worth way more than $100,000, so we'll just underwrite based on your personal financials and we won't need to do an appraisal whatsoever. So the takeaway here is that it's completely negotiable. It's completely different. If you're, comparing with, friends that are doing real estate investing, you may get a little confused of like, well, why did they require a full appraisal for you, but they didn't for me, or vice versa? Why is this so challenging for me? And I'm needing to submit rent rolls and other things, but someone else, they just like click a couple of things on the computer. Just know that that's normal. It's all completely negotiable. And you may ask for a different type of appraisal differently based on what you know about that property. Like I said, for example, if you know it's pre-renovation, you may really want a desktop appraisal. If you know that you've worked your heart out to renovate it, the landscaping's perfect, you just really want that gem to shine, you really want that full appraisal because you want the appraiser there getting that immersive experience.
And the way to get what you want is just to ask for it, and just be very transparent with the loan originator that you're looking for. They want to serve you and they want the best possible outcome. They're frequently, compensated when the loan closes. They want a good outcome. They want to win your business, and they know if you're talking to a different bank and there's a different bank that's giving you a better appraisal option, you might go with them. You want to do like a little role play on what that might look at, that negotiation?
I'm the borrower?
Who do you want to be?
I'll be the borrower.
Okay. All right.
And I'm calling the banker.
Yeah.
Ring, 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 ring.
Hey, Elaine, how's it going?
I'm doing well. How are you?
I'm doing fantastic. I just had your file open in front of me here, and I was just getting ready to order the appraisal. What can I do for you?
I was actually calling to talk about the appraisal. I'm glad you're working on it.
Yeah. Well, what can I do for you?
I'm looking at our closing date and kind of just knowing the schedule of the appraisers and
Yeah,
everything.
they're pretty backed up these days.
Yeah, our last couple of appraisals, even the timeline, like this said it was supposed to be 4 weeks, it actually took like 6. On those deals, we had like a longer closing time. So, that wasn't a big deal, but we just don't have that time right now. We're trying to close by the end of the year. That's really important for like tax reasons and stuff.
I just have to do like a drive-by appraisal. Do you think that would get it done in time, or?
Yeah. I think that'd be really good. I will say it's such a nice asset. Do you think we could just like maybe walk the common areas? I really want to show off, like there's
Sure.
just like ground floor commercial space. Like,
tell you what, could I walk it with you? Could I go see the property?
I would love that. We could grab lunch after a while.
Oh,
It's been a
my
while.
favorite restaurant.
Yeah. I want to hear how your kids are doing.
Absolutely. So I'll just take a few photos and I'll just put together kind of what I think it's worth, run it by the board, see if they're okay with that.
Absolutely.
Would that work for you, Elaine?
And I have a ton of stuff. I mean, obviously, we've put a ton of thought into what we think it's worth. I'm happy to, share all of that with you. I can just give you links to my Google Drive.
You're a licensed agent, aren't you?
Well, Nick is, I'm not, but
Okay.
Nick is.
So Nick could probably put together like a CMA or something.
Yeah,
and I could just like give that to the board, couldn't I?
We'd be happy to do that.
Okay. And I'm working on your file right now. Like, you want to just meet out there right now? Would that work for you, or?
Sure. It's a warm day. There's no snow on the ground. Let's go.
Great. Yeah, I'll see you here in a few minutes. Bye.
Sounds good.
That's not a hypothetical. That's like an actual conversation.
And it would be totally different. Like I just like made that up of like,
Yeah.
Hey, we need to close right away. Let's go. We can't be waiting 6 weeks for a full appraisal. But again, if you had just, worked your heart out on a really nice renovation, you want a full appraisal. You're going to fight for a full appraisal because you want them to give you credit for, your stone countertops, your nicer appliances, all of those things. So it's all very subjective based on your goal for that lending.
And that internal appraisal costs you almost nothing, potentially costs you nothing at all. And if you have a reputation for being a person who is, right on your numbers, you're not exaggerating your numbers. If you are a licensed agent, it's very, convenient. You can produce CMA. If you have a relationship with a licensed agent or a broker, they can produce a CMA or a BPO for you. You can give it to the bank. The bank is not going to let you create undue influence on the process, but you're crazy not to do as much homework for them as you can.
Absolutely.
Because there's frequently mistakes. There's frequently errors. These appraisers are knocking out like 10 appraisals a day, and they're kind of riddled with errors. So particularly on refinance transactions, if there's not a market price that they can, okay, I did several hours of work despite the fact that you're doing 10 appraisals
so
a day.
Many stories like we've totally missed bedrooms. We've totally missed whole floors of houses. We've missed garage. They mix them up.
They just like have a completely wrong property on the appraisal.
Especially with drive-by appraisals, they'll have pictures of a different property. I mean, just be humored by it. Just roll with it. Just know that it's part of the process. But yeah, make sure you're looking at your appraisals and you're making sure all the bedrooms are counted, all the bathrooms are counted, the square footage is right. If there's, something unique or special about that house, maybe the lot size is bigger or something like that, make sure that's captured there.
Yeah, get them signed copies of lease agreements, historical financials, future pro formas, renovation costs. We mentioned like a CMA, a BPO. Send them videos, photos, Zillow links, the identifiers from the assessor, like links to the assessor site. We actually have a whole spreadsheet that we fill out, and we call it a bank package. And we'll give it to the bank, and we will.
I'll put that in our Facebook group tomorrow.
I literally asked the bank and the appraiser, hey, what can you send me like a screenshot of your software when you're doing your appraisal? And they did, and they have about 100 cells that they have to fill in a spreadsheet, so to speak. And so I just reproduce that cell by cell in a spreadsheet, and then fill in exteriors, masonry, and then the default option is, wood paneling, which is a much lower value, veneer. And if they just like weren't paying attention and just, because they got to go through these things so fast, there's no way they could really get it right. The values end up way off. So we will literally just say, here is the type of basement, here's the type of HVAC system, here's the type of roof. And some of the appraisers say, hey, like, I can't let you do my job for me. And then other appraisers say, man, this is so helpful. You have no idea how much this means to me. This is going to save me so much time. And the banks, I would say, universally love it, because it's the bank's job to verify the appraisal when they get it back. So they have to go through and do a cell by cell comparison of the appraisal when they get it back. So when they get our information sheet, they're like, oh man, this is going to make our job so much easier. So at that point, you're not influencing the appraisal at all. You're just making sure the appraisal is as accurate as possible. All of these things are 100% negotiable in commercial lending. When we're in conventional land, like sometimes you can't even communicate with the appraiser at all. Like the appraisal comes back on the wrong property. It comes in short $50,000 or something huge. And you're like, I can see it's a photo of the wrong property, and there's nothing you can do about it. Just your transaction is kind of hosed. And sometimes you'll restart the process, say, okay, can we just get another 30 days to close and go order a new appraisal, because it's so hard to try to fix your appraisal if you have a conventional loan.
Absolutely. So for creative options, there's lots of different creative options that are out there. With conventional lending, they tend to be expressly prohibited. Sometimes you can make them happen, but it's pretty hard. I hope you're getting the sense that anything is possible in commercial lending, and I hope that sense excites you, that you do not feel overwhelmed here. You feel excitement, and you're thinking about, well, how can I put a deal together, or how can I best find, the debt that I can leverage to really make my deal shine. John had asked, can you negotiate down payment on commercial, or is it fixed at 25% for investment properties? So down payment is absolutely negotiable. I don't think we've ever paid more than 20% for a down payment. Some of our loans were even at like maybe 15 or 12%. We've heard for other individuals that are really further along than us on the investment journey that they might get like 10% down, particularly if it's like new Class A construction. You can tend to think 20 or 25% for the extreme majority of lending products in the commercial space.
And we'll get to what constrains the loan here in just a couple of slides.
So for scaling, your takeaway here is that for every additional conventional loan someone gets, scaling gets harder. That's when you're kind of going down into that valley of despair. But then in commercial, for every additional loan you get, it actually gets easier. Yeah. There's something about human psychology that your first commercial loan is going to be pretty hard to get. We're going to talk about our commercial loan, but then once you can call
our first commercial loan,
once you can call a commercial lender and say, hi, Sally, my name is Bob. I have a commercial loan on 123 Main Street from your friend Fred down the street. I now have 123 Sesame Street. I'd like to get a commercial mortgage on that. Oh, you already have a loan with, was Bob, it Fred?
I don't remember.
Oh, that sounds good. What kind of loan do you want? I promise you, like that's the difference, right? Remember Investor One that I shared the story where.
And they're going to call your referral. They might even have a private eye they hire to underwrite you. So make sure your referral is legitimate, and they're going to know, okay, this person, they really know their stuff. They only underwrite really, really strict conservative guidelines. So if they're doing business with them, I can do business with them too.
Yep. So be thinking about, cash out refi as your ticket to scale. It's something that when you master it, it is the ticket that breaks you through. Underwriting, I think we've talked enough about that conventional underwriting, it's all spreadsheet driven. It's all driven by an algorithm. You submit documents, someone punches it into a spreadsheet, it spits out a yes or a no, which is easy when you're getting one house or two houses or three houses, gets harder as you go along. Commercial underwriting is completely different. It's all a negotiation. It's all painting a picture, telling a story, building a relationship of who you are as a lender and what the deal is as a deal. So the underwriting is completely different, and it can be a hard pivot of, you're trying to hand them insurance documents to show what, your monthly insurance is. And they're like, I'm not interested in this. I want to know, are you a good bet? What's your business experience? What's your real estate experience? So that might take you back a little bit of oh, I thought I needed to submit all of my insurance documents because that's what the conventional lender wanted. The commercial lender is looking for something completely different.
Let's do a 15-second role play on what it looks like when you run into a hiccup with a conventional loan.
Okay.
All right. So I'm the lender.
Okay.
Okay. Hey, Elaine.
Yeah.
You know how you were applying for a loan with us?
Yeah.
I'm sorry, your loan has been denied. Goodbye.
Ring, 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 ring.
Oh, yes, Elaine. Why are you calling me?
I'm just really confused. I'm a physician. I own a business. This is my 8th property. The other 7 have been so easy.
The software, you actually have so many properties that are software. It errors out or something like that. I don't know. It's a lot of work for me to put all this stuff in the software. I could probably sell someone else a loan quicker, easier than you. So I'm sorry. I don't know why it rejected you, but I can't work on this anymore.
Wait, you're telling me that my loan is rejected?
I don't know. I just put the things into the spreadsheet and it just says it's rejected. I mean, I could try to call Fannie Mae, but I'd have to wait on hold for 8 hours at their call center. I could just sell someone else a loan in that time. I don't even know where you could get a loan on something you just have too many properties. So I'm sorry, I have to go. Bye.
I wish that was fake.
I wish that was fake. I wish that was a real call that we had with a loan originator that we have a fantastic relationship with. At least they were transparent.
Yeah,
that was a good thing.
It helped us to figure out why conventional lending was no longer an option, because punching all of these things into the algorithm for us when we had, I think we had 14 properties or something at that time, versus punching a few things in for someone that only has one home, the home that they occupy. Just time-wise, it did not make sense to work on our loan because the commission is all the same. And that was the pain that drove us to seek commercial financing.
Here's that same situation, by the way, the exact same problem, but on the commercial side. So I'm going to call you.
Who am I?
You're the borrower. Exact same situation.
Okay.
Hey, Elaine, this is Nick over at Main Street Bank.
Hey, how are you today?
Oh, I'm doing great. So I see you got 7 properties here, and you sent me some stuff. We've got this firewall at the bank and it blocks stuff. I think a lot of stuff didn't go through or our software blocked it. Can you just give me the phone number for your insurance? It seems like you have the same insurance agent and everything, right?
We do, yeah.
I'll just give them a call and just verify that you've got insurance on everything.
Wow, yeah, that would be so helpful. That would save me a lot of time too.
I assume the property taxes are just what it says on the assessor, right?
Yep.
Okay.
Yep. And in fact, we actually own the neighbor. You guys have the.
Oh yeah, I forgot about that. I'll just look that up. I could probably just apply everything we did on that underwriting to pretty much everything you've got here. This is going to save me a ton of time. Okay, thanks. Bye.
Yeah. So different.
It's a very logical, assume a sane, normal human being was underwriting your loan and not a computer algorithm. And that's exactly how it works. A person just calls you.
ChatGPT should underwrite conventional loans.
It's pretty good.
The world would be different.
That's pretty good.
All right. So recourse. Recourse means, is there a person, is there a signer that is ultimately responsible for that loan at the end of the day if things go poorly? With conventional loans, it's almost always full recourse. I don't think I've ever heard of a non-recourse conventional loan. Commercial is, I don't know, 1/3, 1/3, 1/3. I don't actually know the numbers there, but
whatever you negotiate.
Most often it's full recourse, which means If someone, buys an apartment building and plans to pay the mortgage with the rents, and then something happens and the rents don't come in, or there's extravagant maintenance costs or whatever, and there's not enough money to pay the mortgage, that the person who signed that note is responsible for paying the mortgage. And if the person can't pay the mortgage, then ultimately, there's personal consequences like bankruptcy, those sorts of things. There's partial recourse and there's non-recourse. Having full recourse is obviously riskier because someone is putting their personal signature on that loan in addition to the signature of the business, but it tends to result in much more favorable terms because there's more security for the bank. Non-recourse, some might say that it's much safer because the bank can only seize the asset and not any other assets that that person has, but the terms are much worse. So interest rate might be much higher, originations higher, basically other things that the bank can do to increase their profit to make it worth it to have that non-recourse note.
I just realized that I think I cut out a couple slides here to try to get time down to something reasonable.
Yeah, we're going a little over time already.
So a critical concept here, beyond critical, and again, I hope you're jotting this stuff down, is that conventional loans are underwritten to DTI, debt to income. So they look at you as a person. And basically, I'm not making this up. This is 100% straight face true. A conventional lender assumes that 100% of your portfolio will go vacant and catch fire at the same time. That is the scenario that they underwrite to. So they make sure that you can shoulder all of your mortgages, assuming there was like a hurricane or something that wipes out your whole portfolio or whatever all at once. So they're going to require that you make enough money to pay the mortgage and that you have enough reserves to pay all the mortgages, assuming you lost your job and they all burned down at the same time. And they're going to check your insurance coverages to make sure that you have enough money to pay all your deductibles, to repay the loan, assuming they all burn down. I know that sounds completely insane. That is literally how they underwrite. They assume that you are the most inept landlord ever. And so, of course, each additional property you get, it gets harder. And then commercial lending, there is no DTI concept. There is no global DTI concept. They look at the debt service coverage ratio, or DSCR. So to calculate that, you just take the net operating income, the profit that the property produces before debt service, and then they divide that by the debt service. So let's say that your property produced $1,200 per month in net operating income, and your debt service was $1,000 per month in total, principal and interest payment. So you divide 1,200 by 1,000, you get 1.2. Most lenders are underwriting to a 1.2 debt service coverage ratio. I'm going to say the second time. Most commercial lenders, they're underwriting to a 1.2 debt service coverage ratio. So they don't care about how many properties you have. In fact, the more properties you have, the better, because that says that you've done this before and you probably know what you're doing. They are not all concurrently on fire and vacant. So that's a good thing. And they don't really need to be worried about that catastrophic situation. The income from the asset needs to be able to support the debt service, a very reasonable and logical kind of underwriting to make. And when you put together your pro forma, when we put together our pro forma that we share with the bank, we'll go ahead and do that math for them and say, here's how all of our income, here's all of our expenses, and we're at a 1.32 debt service coverage ratio. So we're in good shape. And this answers the question that John Riley asked earlier about, can you negotiate the down payment on commercial, or is it fixed at 25% for investment properties? So if you understand the concepts that I just blasted through really quickly, your down payment tends to be somewhat fixed with a conventional loan, which is a little crazy. And that's because they're underwriting to your global debt to income. So they're just saying, we want a certain amount down, a fixed amount down, just to make sure that you have skin in the game, so to speak. But we're just going to underwrite to the idea that the thing burns to the ground. Whereas within the commercial land, they say, okay, let's reasonably assume that the property is operating with some fair assumptions here. Are you going to have enough to meet the debt service on the asset and have some profit left over? If not, we need to reduce the LTV on the loan. We need to reduce the loan proceeds to reduce your debt service. So maybe they'll say, we'll go up to an 85% LTV at a certain interest rate, but because the asset's not producing a lot of income, or because interest rates are high, so your debt service is high, we can only underwrite to a 68% LTV on this. We are debt service cover constrained. That's the exact phrase there. And that's ultimately what determines your LTV on most of these assets in the commercial lending world. If you have a good lender that you have a great relationship with, and you have a proven track record of success of predicting pro formas and then fulfilling those pro formas, they will underwrite to a pro forma. So you can say in place rent is 1,000, but I know we can rent it for 1,500 a month. So based on in place debt service, or I'm sorry, in place income and in place NOI, we would be at a 0.8 DSCR. So you'd have to reduce your loan size, but we know that when we put our property management services in place, we can make a huge renovation, radically improve everything, improve leasing, improve operations, lower expenses, and we can increase NOI by 50%, something we've routinely done, and they will actually underwrite to that pro forma amount. That's something that conventional loans, they cannot do. So just a word about DTI versus DSCR, how that's such a critical concept to understand, and how DSCR is ultimately the thing that determines your LTV for your commercial loan 99% of the time.
Very good. A couple of good questions have come in. So one of them was, you mentioned a cash out refi with the increase in interest rates. Can you explain why this would still be a good idea? That's probably like the number 2 question we ever get. So anything you listen to, we probably address that question in all of our community hours, all of our teaching. So what we've been really successful with is getting second, and like Nick mentioned, even third pieces of debt on a given property after we've completed the renovations. So we've completed the renovations, we've radically increased the value of that property. We don't want to just let that equity sit. We also don't want to sell. We are not sellers. We've never sold anything, but we want to harvest that equity to then be able to go out and buy the next property. So what we've been able to do is work with our commercial bankers to keep that first mortgage and then to put essentially like the equivalent of a HELOC. It's called a commercial line of credit, a second piece of debt on that property that gets us to the 80% LTV that we want, that gets us to that cash out refi, but preserves our low interest rate debt. And then let's say that wasn't an option. And then at that point, it really just becomes a function of, with the higher interest rate debt, can you still cash flow? Can you still service your debt? And are you harvesting enough equity to make it worth it? The definition for us is that we're harvesting enough equity that we can go do another whole deal. And if that's possible and the original asset still cash flows, then we have a cash flowing asset that, yes, it has higher interest rate debt than we would like, but we've harvested that equity to go out and buy the next asset. Very good question. Another good question is, what is the current rate range for a commercial loan? So 100% negotiable. I hope that's the clear pattern you're seeing here. I would say the numbers that I have seen in the last, say, 30 days, so that they're relevant, is low 5s to low 8s. Obviously, that's a huge range. But for someone that is inexperienced, maybe it's their first commercial loan, or they're working with a new bank, it might be high 7s, low 8s. For someone with a lot of experience and a great lending resume, it might be in the low 5s. The number that I see kind of over and over is like 5.756%. I would say that's a typical number that I'm seeing.
It might be 8% for an 85% LTV and 5% for a 25% LTV, because that lower risk loan has a lower, has a premium in the form of interest rate associated with it. And it depends on your track record and how much they like the asset. Which kind of answers Mark's question there: a commercial loan approval or denied based on the DSCR.
Oh, so I think Mark is answering Jeff's question. Is a DSCR loan the same or different as a commercial loan? So a DSCR loan is like a specialized type of commercial lending product because it's typically a portfolio loan. It typically has higher expenses and a higher interest rate because they tend to be a little riskier than what someone might consider to be like a traditional commercial mortgage that someone gets from a traditional commercial lender. There's like a lot of subtleties there. So yes, a DSCR loan is a commercial loan, but it tends to have more expenses and less favorable terms.
Yep. And one critical concept to understand. So right now, a commercial loan is universally cheaper than a conventional loan. It's a rare circumstance where you get a better rate on a conventional loan than on a commercial loan. That's really weird historically. Typically, for decades, a conventional loan, you get a cheaper rate than a commercial loan. But what happened was, during COVID, the Fed bought up a ton of mortgage-backed securities. That was their way of injecting money into the money supply. So they bought U.S. Treasuries and they bought mortgage-backed securities. Those are convenient ways to deploy capital into the marketplace, and they were able to inject that capital. They have to get that capital back out, and what they're doing is they're letting those mortgage-backed securities lapse, and they are and selling those mortgage-backed securities. And what that does is, when they were buying those mortgage-backed securities, that pushes down the rate. So that's how you can get a 2.5% conventional mortgage. And they're going to be selling those mortgages for years to come. They have billions and billions of dollars, these mortgage-backed securities on their balance sheet. So that's going to push up conventional mortgage rates for years to come, as long as the Fed is unloading them from their books. So that's going to synthetically increase the rate on a conventional mortgage. So for the foreseeable future, commercial loans will be a lower rate than conventional loans.
So you must master commercial financing to scale.
This is a very time-sensitive thing.
It is always important, but it's particularly important right now with the lending environment that's out there.
If you go back 2 years, we were helping a lot of investors buy homes with conventional mortgages, and they could go get like a 3.5% conventional or a 6% commercial. It was like double the rate to go commercial, because that's when the Fed was buying those mortgage-backed securities. Now that that's flipped around, you can go get we just help someone get approved at 5.75% for a commercial loan, and they're at 7.5% on conventional. So this is just an unbelievably critical skill set to master with the market being the way it is today. And the market's probably going to be this way for quite some time.
Absolutely. Mike asked, is it common for commercial lending to have early termination fees for refinancing before the term of the loan ends? Yes, absolutely. That's called a prepayment penalty. Again, completely negotiable. We are very transparent with our banks that our business plan is a cash out refi plan. So that prepayment penalty is very important to us. That may be less important for someone that just has kind of a buy and hold, like steady business plan. So we work really hard to negotiate that down as much as possible, or to have what's called a 3-2-1 step down penalty. So for the first year, it's 3%, the second year, it's 2%, the third year, it's 1%, the fourth year, it's nothing. Well, our business plan is to refi in less than 5 years. So that's essentially, we're giving the bank a little bit of what they want. They're able to say, well, I got a prepayment penalty written in. So if they change their mind and pay off the loan the very next day, they're compensated for that. But it works for our plan because it fits within our timeline. So prepayment penalty absolutely exists.
And you can negotiate so that the prepayment penalty does not apply if you get a refi, that it does not apply if you sell the asset, and that the prepayment penalty does not apply if you pay it off with cash, which basically means you just can't refi it and take the loan to another lender. And again, it's all negotiable. So it doesn't probably cost you anything to ask them to put those additional terms in there, but that could save you tens of thousands of dollars in prepayment penalties in the future. Yeah, those are slides we dropped from the presentation to try to save time.
Clearly, we should have
left them in there. Yeah.
All right, so let's talk. So we've talked terminology and given you the basic language that you need in your emails, your phone calls, your lunch dates that you have with these bankers. Let's actually talk about boots on the ground, how you make this happen.
I just noticed I don't think a single person has left this whole time. So apparently we got good stuff here.
Yeah. We'll probably go for maybe a little bit less than another hour, just to kind of give you, some planning for your evening. A replay does go out if you need to, kids or sleep or whatever it is. A replay does go out.
And we hope you're taking notes, because we're about to give you the recipe. Like, you go get a loan tomorrow.
Yep. So how to find a bank. Get a referral, get a referral, get a referral, get a referral, whatever you have to do to get that referral. Hopefully you're investing locally and you're able to figure out, this person goes to school with this person, is on the same soccer team as this person, or has done business with this person, whatever it is. If you're investing out of state, hopefully you have a great team there. You're able to get a referral from your real estate agent, your contractor, your property manager, other real estate investors that in that area. A referral makes all of this, 90% easier. If you don't have a referral shaves a point off your rate out of the gate. I would agree with that. Yeah. If you don't have a referral, some things to think about are, who do you have your depository business with? So where are your checking accounts? Where are your savings accounts? Make a list of your top 5 local favorite local banks. I'd probably bump that number up to 10.
Yeah.
I just want to give you the sense that you will need to pound the pavement. You will need to put in the hours. You will need to put in the reps.
Who are the banks that are sponsoring charitable organizations in your area, that are doing, fundraisers for children with disabilities, that are supporting the community? All commercial banks have a charter. They function to support the community, to lend to the community, to support business and real estate investment. And the banks that are the most active are the ones that typically have the strongest charter, that are the hungriest to lend money. The banks that are maybe older, stodgier, those are really aggressive generalizations. They're going to be less likely to lend you money.
The smaller, the better. So we always say local and regional banks. There's really a distinction there. A bank that only lends in one little city is similar but different than a bank that lends in maybe like one whole state or a few neighboring states. Physically close to the subject property is very important, and make some calls and schedule some lunch. This slide might look easy. It can take some time. You're not crazy if you get a lot of no's. Stick with it. Know that the breakthrough comes after the breakdown, and you're working on building a relationship. Just like, if you go to, I don't know, the mall, you're not just like instantly friends with everyone who's also at the mall. As you're making these calls, you're building that relationship, you're building rapport. You might get a lot of no's, you might get a lot of confusion of, I'm not sure what you're looking for, I'm not sure what the department is. You will figure out how to make some inroads. And once you make a few, it gets exponentially easier after that.
You figure out the script, you figure out the recipe they're looking for. And there's limiting beliefs for every single one of these. You can say, well, I'm doing business in a different geography. I mean, we've had some of our investors fly out, and we will schedule meetings where they will go meet face to face with 3 or even 5 different banks. You can go to a coffee shop and post up and just schedule back to back meetings with different commercial lenders. You can meet face to face with 10 bankers in one day in a geography you don't live in. It's 100% possible.
Yeah.
And to say that you can't meet face to face, that's purely a limiting belief. I promise you, meeting face to face will shave a point off your rate. And this adds up. If you get a referral and you meet face to face, your rate's 2 points lower than if you just cold call someone.
Yep. So what do you need to bring to your first date? So you've posted up at this local Starbucks or a local coffee shop, and you've scheduled, say, 4 bankers to see you every hour for the next several hours. What do you need to have with you?
Yeah.
You need to have your personal financial statement, your PFS. Here's a pro tip. Make your own PFS. You can fill out the bank's PFS, and they will even email you a copy. And it's a pro move to say, here's my PFS here, and it's implying that I do this all the time. I have one. I'm checking my net worth with myself or my spouse already. These things are already important to me. I already have one on my template. It's also a way for you to really make the parts of your personal financial statement that are the strongest really shine. So if you have, say, a lot of real estate, you're going to have a big bold section that says schedule of real estate owned and all of your real estate under that. Maybe you don't have a lot of real estate, but you have, shares of a private practice or a business or something like that. You're going to have a big bold header that says business is owned and information there. Whereas on like a template personal financial statement, it's all just little boxes. And if your stuff doesn't fit in that box, you kind of don't know where to put it, or you don't know really how to highlight what you have going on in your personal financial situation. So it's a pro tip to have your own. You can Google versions of them. I can put a link into our Facebook group tomorrow too. So I'll put our appraisal worksheet, and then I'll put a blank personal financial statement. But you really want to personalize it. It's very different for different people based on what you have going on in your own life. And it's basically just all of the assets that you have, all of the debt, subtract the debt from the assets, that's your net worth. That's your personal financial statement. Personal financial statement, PFS, and balance sheet are the same words.
Yes.
3 years of your tax returns, a professional resume, a real estate resume, and a credibility deck. So we'll show a credibility deck here. I really want to speak to professional resume because maybe you're thinking, I don't have much of a real estate resume. I have 1 property or 3 properties, or I've only been doing this for a few years. I don't really have much. But it's likely if you're on this call, you are a high income professional. And it's likely if you're on this call, you're a physician, an attorney, a CPA, some sort of profession where you've had a lot of schooling. And even if you haven't had a lot of schooling, if you have a lot of years in your field, you really want to make sure you're capturing that, because what you're trying to show here is, of course, income. Like banks are concerned about money and is there enough money to pay for the debt? But what you're really trying to show is stability. You are the kind of person who can set a goal that's 10 years in the future. I plan to be a physician, despite the fact that I have to go to undergrad, then medical school, then residency, and not sleep for 12 years. I did that. Therefore, I'm the kind of person who's good on my word. I'm the kind of person who's going to pay my debts. You want to paint this picture of whatever it is you have going on in your life. If maybe you're thinking, I don't have a lot of schooling, and that's a limiting belief of, oh, I can't do this or I don't belong. It's completely untrue. Think about what is going well in your life, what is going well in your profession, what can really make you shine, what can make you look like a person who is a person of your word, a person of character. It can be something as simple as I've been going to this church for this many years and I'm part of these committees. I serve in volunteer work in this organization. It's all relationship based, and you're trying to let them know that when they give you debt, you are a person who is good for it, and you're going to make sure that that debt is paid back. Time for a credibility deck? Or do you want to keep?
Let's keep going, and
Okay.
then we'll do the credibility deck. Yep. So when you're on that first date, keep in mind that you're talking about getting married, and it's not very cool to propose marriage on the first date. So you just want to get to know them. You want to be chased. You don't want to chase them. Hey, yeah, I'm just meeting with a few lenders here. We're shopping for the best fit. Building a long-term relationship with a lender that we can buy many properties with in the future. And I'd just love to get to know you, give you an opportunity to get to know me. If there's anything that you need, I've got a stack over here. I have printed off and also electronic versions I can give you of 3 years of tax returns, personal financial statement, personal resume, professional resume, real estate resume. All these different pieces. In fact, I've got a whole PowerPoint show I can run through with you if you want. But right this moment, I would just love to get to know you. What are your kids' names? What are what professional associations? What's your favorite charity? What's the greatest moment? Go research 36 questions to fall in love, and jot those down and just ask them a few questions to fall in love. So incentives are everything. A loan officer, they typically get a commission when they sell you a loan. So they're a salesperson. They're a commission salesperson, and they really
I just dropped that in chat, the 36
Yeah.
questions to fall in love.
But then temper that with, there's a saying in lending that the only way anyone lost their job at a bank was to write a bad loan. So a bad loan is like patient mortality in the medicine world. You never, ever, ever want to write a bad loan. And we've stepped in to clean up a lot of messes, other loans that have gone bad. Very frequently, we'll get kind of a feverish call from a lender who says, hey, Nick and Elaine, we've got a loan that's not looking so good. Is there any way you might be able to buy this thing, before the loan, kind of blows up on us? And we'll give them a call. We'll make sure that they take your call and they're really incentivized to take your offer. And then shortly after that banker has taken an early retirement at the ripe old age of 35 or something like that. Just that's how the system works, which is actually a pretty good system. So if you write that loan, you own that loan for the life of your career at the bank. You actually have a list of loans that you get a report on every month and what the status of that loan is. And if there's any, warning statuses, you're on a watch list with the bank, like that person who wrote you the loan, they're calling you saying, hey, you want to go out to lunch? And yeah, I noticed you didn't make your most recent payment, or you've been making payments late. What's going on? How are things going? Could we go tour the property together?
Mhm.
I'd love to meet with your accountant. They're going to start digging into your situation because they have all the skin in the game. It could be the end of their career if they write a bad loan. So on the one hand, they really want to get to know you. That's why referral is so valuable, by the way, is because that gives them a sense of emotional certainty. The two emotional, angel and devil on their shoulder, however you want to think about that, is, hey, I can sell this person a loan and earn a commission. Is this person going to make their payments? Is this loan going to go bad? That is the only question you ever need to answer in their mind. And they're going to do whatever they can to get you a loan that's going to work for you, that they're going to come out on top if you're talking to multiple lenders. They're going to do their homework on you. They might engage a private investigator to research you. Be prepared for that. You probably won't notice, but you might have someone gets a call from someone. Hey, someone called me just to ask about you, or they said they were working on a loan, but it was kind of a weird phone call. I think they're a private eye. Are you okay? What's going on there? They're going to call the referrals that you give them. So make sure you're giving them, real referrals that people can follow up on. And don't be afraid to overplay the fact that you are a physician. Bankers love physicians. They're the most bankable profession. So hello, my name is Dr. Elaine Stoggeberg, MD. I trained at the Mayo Clinic, did residency and fellowship there. What was your name? Don't be quite us, but it's a very, very, very big deal. Your MD will shave a point off your loan.
Sorry, I muted there so I could cough. Tried not to cough in all of your ears.
Yeah.
All right.
Very few people know about commercial loans, by the way. That was the last bullet point there. They're not really advertised. It's more of a referral business, but they love selling those loans. They just don't. I hope it makes sense to everyone here why a bank is never going to put up a billboard to sell a commercial loan. Because that's the last thing they'd ever want is a stream of people coming in without referrals that they then have to do all these background checks, make sure that they can trust that they're gonna repay. Commercial lending is kind of an inside game, and it's a hopelessly unfair game. But the good news is you get traction, and eventually you now have this huge advantage over people who aren't yet established in the industry. So it's not something where you can just snap your fingers and overnight you've got amazing commercial lending relationships. You have to build those relationships over a period of years, and then eventually you can make a phone call and get $15 million of debt in a 5-minute phone call. So you've gone on that first date. Maybe you've had a second date, and you've gone through a credibility deck. I think Elaine's going to be back here in just a moment. Let's take a quick peek at that credibility deck and see what that looks like. So we're going to actually show you our credibility deck from early in our investment career. So just pulling that up here. I've got our credibility deck pulled up.
All right, I have some water. I'm no longer coughing.
So hypothetically, you've got a credibility deck. By the way, I don't
think we're sharing it.
Yeah, I'm going to put over there in a second.
Okay.
By the way, I have never seen anyone do this for, like a single family home before. This is typically like something, this is like a Blackstone maneuver or whatever. This is something like an institutional player would do, but act like you've been there before, like play like the pros. And I would say 90% of the time, the bank didn't even want us to go through the presentation. We would just show them that we had it, and they'd go like, wow, you all really have your act together. What does your PFS look like again? Like you've only got $1 million in assets, but you've got a 17-slide credibility deck. If you can't tell, we like doing slideshows with audiences here, and it won us massive credibility. Like one of the bankers, they're like, man, we've never seen someone this early in their career that has a whole credibility deck put together. We want our chief risk officer to fly out just to see your presentation, just so you get to see like what the game looks like at the next level, like just to do you a favor.
I still remember what I wore. I remember where I sat.
Yeah,
that was
fun. Absolutely. So we're gonna run through this. I think that's not working because I am trying to do 2 slideshows at once. So
there's a beautiful picture of our family in Jacksonville, Florida, when I was pregnant with Micah.
There we go.
And now we have our original credibility deck. So let's try to run through this in 3 minutes. Yeah. So this would take maybe 20 minutes to run through.
Yeah, as long as it made sense to you. So our story, and by the way, if this should look familiar to you, this is the same slideshow we do today. Professional resume.
Yep. So here's where, we talked about, who we are as people, who we are in our professions, again, trying to paint that picture of stability, longevity. We talked about Rochester. So even though we were in Rochester talking to a bank that was headquartered in Rochester, we reminded them of why Rochester is such an amazing market, really, reminding them of things maybe they didn't know. Maybe they didn't know that Rochester is the #2 best city for children. They know it's kind of a nice place to live, or heck, maybe if it's winter, they're thinking like, I hate Rochester. I don't know why anyone lives here. And we're like, did you remember that Rochester is the #1 place to live in the country many years in a row? This is a good place to own real estate. Talk about Destination Medical Center. The Rochester.
Oh, this is a jujitsu thing. So everyone here complains about the regulation. And we talk about how Warren Buffett loves moats around his assets that protect them from competition. So we're talking to the banker who probably was complaining about the regulation here on their last call, about how amazing this is because this protects us from competition.
Yeah, that was fun. We did our org chart of how many properties we have that we're growing, other sources of income that we have, really just trying to paint a picture here that we do a lot of real estate. We're very much in the real estate space. We have a lot of sources of income. We have a growing portfolio. So we did this credibility deck when we had 13 single family homes and 3 duplexes, to give you some sense. Showing off our renovations, like just minor things that you can do in PowerPoint.
LTV was very low, 53% global LTV.
Yep. So, minor things that you can do in PowerPoint. I mean, heck, today you can send your pictures to someone on Fiverr or Upwork, and they can like really nicely format your PowerPoint shows. But if you already have a little bit of real estate, show them the work that you've done. We were talking about our property management company.
Vertical integration was a big deal back then. Even, I mean, it's a huge deal today, but that was unusual that like they'd never seen that before.
Yep.
And it made a big deal.
So if you self-manage, I encourage you to give your management a name.
Yes.
It's very different to say, I have a company, Black Swan Living, that does my property management versus I self-manage. So you can do that. If you have professional property management, make your professional property management shine here, whatever it is you want to show that the assets are being well taken care of.
Professional resume. That was back when we were merely in the top 10%, not in the top 1/3 of 1%. But we made 6 figures in commissions and 3 million in transactions, not 75 million, but is a big deal. It was a very big deal at the time. I'm a professional in the industry. You can trust me. We were doing coaching back then at like local real estate meetups and stuff. And that's a big deal to be a thought leader. We were a values-driven organization back then, just like we are today. I guarantee you this banker has never seen a PowerPoint show from someone who needs like a loan on their 5th property that talks about the values that drive their real estate portfolio. How we get the job done, how we make money, running through an example property, before and after photos, the types of renovations we did.
This was not the property that we were seeking financing on, but it was like the most recent deal we had done, so we could show the full life cycle.
Yep, the exact timeline to go from purchasing the property to renovating the property. So it took us about 120 days of total, kind of turn time to get through everything, mostly because we had to wait for the drain tile system. This is a fun one. We didn't even necessarily have the title on the deal before it was renovated. This was a REO that fell through with another agent.
So these were the befores.
There's the
before and
on the
after.
left is the before, on the right is the after. On the left is the before, on the right is the after. On the left is the before, on the right is the after.
That's how we drove most of, go back one. That's how we drove most of the value in that property. Was we cured the water intrusion problems in the basement. We laid new flooring. We painted the fireplace. We did a full paint there. We added some lights, and we turned it from, an unlivable, kind of scary space to a nice, livable, large second living room.
Yep. How do we find deals? So we use software at the time called Deal Machine. We don't use that anymore, but it literally plots all your driving routes. So just showing we have the grit to go. We drove every single house in our community, took photos of them, had direct mail campaigns.
If you're able to see, I'm just having fun walking down memory lane.
Oh, this is a lot of fun.
If you're able to see the mouse, so this particular bank was located right here.
Yeah.
So we purposefully chose a route that we had driven of, we're looking for real estate in your neighborhood. Your bank is right here, and we love this neighborhood across the street. Today, this is really sweet. We own this,
yep,
all of this, working on some of this. It's fun. It's fun to look at.
Pretty fun. And this bank, by the way, is writing debt on like $20 million or $10 million of assets in Real Estate Fund 1. So this relationship continues to pay dividends. Here's our property management software. And you can see the outstanding balance on 2011 Edgewood Court. That's the example property that we just renovated. How even though we have a small portfolio, we still have professional property management software with like a portal and a tenant screening process and everything. Here are photos of books, because it sounds crazy, but most people
go through that.
They don't keep books.
Name on it.
Yeah. So we actually do accounting. We put these numbers.
I mean, think about how simple this is, right? Like I look back at it and I'm really sort of amused by it. It's kind of so cute, but we're just basically saying of course we have books. Of course we manage our properties. Of course we have nice photos. It is such a presupposition that we have all of these things that we're just going to check them off for you. You don't have to ask us about, well, how are you making sure that rents are paid or bills are paid? We're just doing this all day, every day. We're good, trustworthy people. We have some real estate experience. Here's a deal that we recently did. Here's the systems that we have, our values. You're answering every question. You're telling every story.
Just like how with the appraisal, we would put together every piece of information about the property, do the photos, do a video, put together a CMA. We literally do the appraiser's entire job for them. We're doing the exact same thing here. So what are the questions that the lender needs to ask in order to successfully give us a loan? And we have a slide to pre-answer that question before they even need to ask it. And we've had some lenders just go through that and go well, you just did my whole job for me. Thanks. Yeah, I'll get you a loan here in the next few days. It's that simple. Of course you'd have a slide that says, how are we protected from risk? but we've never seen anyone who actually just, says plainly, this is how we're protected from risk. So put together your own credibility deck. Have your PFS,
Don't think
tax
too hard
returns.
about it.
Yeah.
It need not be perfect. Just think about who you are, what are your strengths, what are the systems that you have in place, what is your real estate and business experience. Start putting some slides together. Tell a story of why you are a good lending risk.
Yep. And feel free to throw questions in chat. We're going to be able to get to questions soon here. So you went through your first date, you went through your second or third date. Maybe that was a phone call. You gave your credibility deck, all your stuff. They did some underwriting, and they came back and they said, oh gosh, I just loved meeting with you. I loved your story. You are really going places, but I'm sorry, it's just not a good fit right now. If this was
This happens to us all the time,
daily.
Like, I do not want to give the impression that we can just pick up the phone and get debt. To some extent we can, only because we have worked on it for the better part of 10 years, but we still get a ton of no's. So I want the takeaway to be that it's totally okay to get no's, and to understand the no, and to understand that it's not personal, right? It's all about your mindset of what you think about that. If you think, well, I've gotten one no, or heck, I've gotten 3 no's. This is just, it's not for me. I'm just going to stop real estate investing, leave my money in stocks. I have no control over my financial future. That was a big waste of my time. That's a totally different story than, I wonder why it's a no. I wonder what I can figure out. I wonder how I can stay in relationship with that person. I wonder how I can get better at creating these relationships in the future. But a lot of it's not personal. A lot of it has to do with the bank. And many of the no's that we have had, we now lend with those banks because something happened either in what we were doing or what they are doing, and our needs matched each other.
So just going through these bullet points really quickly, you should ask the banker when they say no, why did you get a no? And they'll tell you. Like, it's very logical and analytical. A lot of people don't ask, and they won't tell you unless you ask, just like anything. But they may have too much debt outstanding. So for example, there was a bank we were working with, and they had too much debt outstanding at that time. And they had lost a big depository business client, and that client if they withdraw $1 million, that's $10 million in lending that bank can't do it. So it's a 10x multiple. And so they said, gosh, we had you approved, like a week ago, but this big depository business pulled out. And so we can't write you a loan anymore. To which I said, okay, well, what if we put down $1 million in depository business and we replace that client? Could you write us a loan then? And they said, oh, well, sure. Yeah, we could give you a great term sheet then too. Now they should have asked us, right? I shouldn't have to propose that, but you have to do the leading here. That's all there is to it. Let's say a bank, they say we can only have 1/3 of our debt in real estate, 1/3 in manufacturing, 1/3 in business, commercial businesses or whatever, and they write a really big loan on some other apartment building. Well, they're over allocated on apartment buildings. They can't issue any more apartment building debt. And that, again, nothing against you. And then you typically have a lending limit with an individual person or an individual entity. And sometimes they say, we don't want to work with someone who has a portfolio below this size, or we don't want to work with someone, and we don't want to work with someone who has a portfolio above this size. They want someone to be big enough that they have track record of success, but the bank doesn't actually want to do business. Like, a regional bank does not want to lend money to Blackstone, because Blackstone is like more powerful than the bank in that relationship, and the bank's uncomfortable with that. So if you don't have a big track record yet, you just need to prove that you have more track record. But taking a look at this list, can anyone think of what the most common reason is why we cannot get debt today? Why we'd get a loan? Probably at least one no per week. Why would Black Swan Real Estate get a no from someone today?
I'm curious what everyone thinks. It's a crazy question to ask. I love it.
Because again, we get a lot of no's. So why would a bank look at this really strong track record of success, this big successful portfolio, and why would a bank say, I'm sorry, you're just not a good fit for us right now?
Any thoughts?
Too big. That's right. They look at us and say, our bank is only $100 million bank, only a $100 million bank, and y'all have $300 million in your portfolio. So you're just too big for us. So you actually have a huge advantage over us, that there's a ton of regional banks at this point that we can't do business with. And one of these days we might have to resort to going to Wells Fargo. I might quit before I do that. But so you have a huge advantage over us. And getting a no because you're too small is the exact same as getting a no because you're too big. In fact, at least you can grow into getting a yes because you're too small. I don't see us shrinking to get a yes because we're too big.
Absolutely. All right. So what if you have the good problem of more than one bank wants to lend to you, and you may find that happens, right? Especially, right now there aren't as many deals happening. The market has kind of like clenched up. Like the market is so hot that it's kind of frozen, which is like a fun thing to think about. So banks are hungry for business. So maybe you follow all of the steps that we talked about tonight. You have your credibility deck, you have your meetings, and you get 3 emails back of, hey, we're interested in lending with you. What do you do then? So really that second bullet point is the most important part.
Yeah.
Preserving the long-term relationship is your number one priority. Preserving your long-term relationship is your number one priority. So Mark says, ask for the term sheet.
Yes. Yep. Put it in writing.
So a term sheet is all of those vocabulary words that we talked about in like the first half of our presentation. What is the amount of debt? What is the LTV? What is the term? What is the rate? What is the origination fee? What is the amortization? Are there any other considerations that the bank will ask you to have, like say, open a checking account or do any particular thing? Get all of that in writing. And then our recommendation, what we do is a little bit different than when some people do. Some people recommend you sort of run an auction, or you sort of like pit people against each other.
Take that term sheet across the street, like give that term sheet to another banker and say, can you beat this? Which might get you a really good loan this time around, but that banker now knows I better never give this person a term sheet, because they're just going to take it right back across the street. So it's a big deal when they give you a term sheet. That's technically a kind of leverage that they can give you to take your business elsewhere, but you really want to get those terms in writing.
Yep. So what we have found has been very successful with getting the best lending on that particular deal that we're working on lending for, while maintaining the relationship, is asking for a single round for the highest and best.
Yeah.
So we might get our term sheets, and then we don't share them with anyone. We definitely do not send a term sheet either by email or physically give it. We never share a bank's term sheet. And we will say to them, just like we won't share your term sheet out of respect to you, we're not going to share, so-and-so's term sheet with you. But then we compile the best of all of the numbers, and it's often different, right? So maybe bank 1 has the best LTV, but bank 2 has the best term, but bank 3 has the best rate, and bank 4 has the best origination. Very likely to happen. That's just kind of randomly how things happen. So we put all of that information together. We're extremely clear with the bank that we do not have one single proposal that have all of these numbers. We never want to lie or stretch the truth or anything like that. But we say we've received a number of proposals. The best options that we have across these proposals is this LTV, this interest rate, this term, this origination. This is across all of the proposals, not one single proposal. Please take a look at this, fine tune your proposal, and have it back to us in 24 hours, 48 hours, 72 hours. The longer you can give, the better, but you do want to get some sense of urgency there. We plan to make a decision 24 hours after we get our term sheets. If you have any questions, let me know. That's how we do it. I find that that's been very successful, that banks know that we're not pitting them against each other. They know that we're not fabricating fake term sheets that don't exist. They know that we're very excited to do business with them, and they know precisely why we choose not to do business with them. I really would have loved to go with your bank, but this other bank, they were able to do that 10-year term that we really like, and you weren't able to get that one across the finish line right now. Or you were so close, but this other one was a 0.25 interest rate lower, so we just had to go with that one. Next time, please get me your most competitive term sheet, and interest rate is what is most interesting to me right now. So it's not always interest rate. Sometimes it's term, sometimes it's LTV. Right now it's interest rate. So right now, this is the thing that's most interesting to me. When I call you in a few weeks or a few months, that's what I'm most interested in. That's what we have done. And then always have a backup plan.
Yep. So if you move forward with 2 banks, that's not crazy. Just be transparent about it. But it's not uncommon for the lending to struggle a little bit. And what we'll do is we will share our term sheet, our net term sheet, after the deal closes. So like, a week after the deal closes, I'll typically follow up with lenders and say, hey, just want to let you know we did close on this asset. We want to celebrate. hey, would you like to get lunch? So you typically have a celebration dinner with the winning bank. We have celebration dinners with the losing banks. Why would we, so we never say bank XYZ, gave us this while we're in the heat of the things, that's a very aggressive negotiating practice that I think really kills your relationship. Why would we tell the bank what the winning term sheet was after we've closed? Why would every bank be unbelievably curious, excited? Why would it be so valuable to that bank? Yep. So they know what the competition is doing. Yep. And specifically what the competition is doing for us.
They know what our standard is.
They know what our standard is. So what happens the next time we're shopping for debt? They have a better offer next time. That's exactly right. So they're going to go to their lending committee and they're going to have it in their notes. They're going to say, last time we offered this and they got this. So we gotta really roll out the red carpet and do what it takes to win that business.
Or we can get to a no faster.
Yes.
And that saves everyone's time.
Yes.
Right now we're not able to get to that LTV. Maybe we are able to do that in a year, but that saves everyone's time and preserves the relationship, because then you're not negotiating with a party that the parties can't come together. Right? Like the thing that kills a relationship is you negotiate over and over and over and you don't actually get deals done. Then when they see your name in email or on their phone, oh, that's just a person I don't get deals done with, versus, hey, I got to a no really quickly, but call me on your next deal. Yep. This one, we actually got a big loan paid off. We have more money to lend. Like, that interest rate is tough, but I think I can get loan committee to make it happen.
Yep. A lot of people will advise you to just kind of like wear down banks and do a highest and best, another highest and best, another highest and best, to try to shave, a tenth of a point off the rate. And I have had a market president, a person who has 20 bank locations, say, that happened to me with so-and-so 10 years ago, and he took the loan across the street over a tenth of a point, and I will never do business with him ever again. Like I put 100 hours, I put my name on the line, and ultimately we lost the business. So that's the worst possible outcome you can have. So I think we put together a pretty good formula to really eliminate the possibility for hard feelings, but still get the best rate for this deal, and critically get an insane term sheet for the next deal. And we're always working a deal ahead. Hey, sorry you didn't come out on top the last time, but would you be able to give us this deal? Does that sound familiar? That sound a lot like that phone call that we just had on how we got $15 million of debt in 15 minutes.
Absolutely. So what comes next? So after you and the banker have decided that you'd like to move forward with a loan at that bank, then you go through underwriting. So the loan officer, you can kind of think of that person as like similar to like your real estate agent. They're there to represent your needs, to kind of walk you through the terminology, tell you about the process for their bank, collect paperwork, those sorts of things. They submit your file to the credit analyst, and that's that good cop, bad cop relationship. So the credit analyst, you rarely, if ever, talk to them. I think we've talked to credit analysts, I don't know, a few times ever. And even then, like usually the loan officer's on the line, because that credit analyst is there to represent the bank and is there to keep borrowers away.
Yes.
So at this point, you and the loan officer have an agreement that they're going to help you get a loan at the bank. And the credit analyst is basically going to say, what are all the reasons why we shouldn't lend to this person? And the loan officer is going to help you through it. They're going to say, hey, you only sent 2 years of tax returns. Can you send a third? Or, hey, you had 3 years, but 3 years ago, that was 2020. Things were kind of hairy. Can you send me your tax return from 2019? I bet it looks pretty good, right? They're going to ask you for information to strengthen your case. You want to be prompt and responsive on getting information to your loan officer so that they can communicate with the credit analyst and provide the reassurance that the credit analyst needs to extend that credit. The loan then goes to loan committee for approval. Every bank's a little bit different. Sometimes there's like a smaller committee that meets with a bigger committee that meets with a bigger committee. Obviously, the bigger the loan, the more committees. If it's the first time that you're lending with that bank ever, the more committees. So it's a little hard for us to give like very specific instructions on, how it will get through loan committee, but just know that there's a board of people that are getting together that will approve or deny all of the loans that come across their table that day. And it's totally okay to ask the loan officer, what is your loan committee looking for? Who is on your loan committee? What are their preferences? They have a bias against business owners. okay, I'd love to send, 10 years of business financials to you to show that I've been in business for a long time so that we can clear that objection right away.
And we have a pretty good fallback career being a doctor and technologist.
Yeah, so whatever it is, that loan committee, it has a personality. It's a living, breathing, voting committee. So ask your loan officer what you need to do to have the best chances with the loan committee. After that, depending on the size of the loan, the size of the bank, it may go to a bank board, which you can essentially think of as like a higher tier loan committee. Oftentimes the terms change and they get worse. So this is a time where you just want to stay in good relationship with your loan officer. So they're there fighting for you. They're there explaining all the reasons why you're a great lending risk, that they've had lunch with you, they've looked at all your stuff, they've walked your properties, they've come to know you and to trust you, and they're trying to transmit that trust to people whose express job is to not trust you, is to protect the bank. So when terms come back and they change, maybe interest rate gets a little bit worse or they shave a little bit off of LTV, it's certainly okay to ask your loan officer, is there anything I can submit to help with that? Can I submit an improved rent roll? Or, we renovated both bathrooms, but I only sent pictures of one. Can I, head over to the property and get pictures of that second bathroom? Is there anything I can provide for you to help you? But you don't want to push too hard because you don't want to put that person in a situation where they're going back to loan committee over and over and getting no's and just kind of wearing them down. So you want to think of this as a collaborative relationship, but just be prepared that things may change a little bit. The appraisal is received, reviewed, final approval, and then there's closing. A commercial loan is completely different. It's often attorney prepared documents. So it's just a contract written on regular paper, a Word doc, in legalese, but written in plain English, a little bit different than like a typical, conventional loan where it's all, standard language and the font is like size 5 and you have to just agree to everything. There's more negotiation that can go into closing, and then all of those terms and everything that you worked on are written into that contract. You sign a mortgage, which is you giving the property in exchange for the loan. You sign a promissory note, which is your promise to pay that debt. You sign recourse if you're doing that, and then you sign your loan covenants that you promise to keep insurance and those sorts of things.
It's a fraction of the documents for a
It
conventional
might
loan.
be 20 pages.
Yeah.
It's your first commercial closing, like you'll have your pen ready and you're like ready for the next document and they're like, we're done. And you're like, oh, but we didn't sign like half the papers. And they're like, that is all the papers. And it's kind of a fun feeling.
Yep.
Someone asked, could both of you belong to a bank lending committee? Given your your expansive expertise in real estate, could a bank hire you to be on their board to vet loans? Yes. So it's it's very explicitly a goal of ours to serve on loan committees in the future. That's a nonprofit position, similar to you typically don't take compensation for that, similar to being on the board of directors of, say, a nonprofit or something like that. But bank loan committees are comprised of people who have excellence in business in that local area. So they might have a couple real estate investors, a couple of business owners, maybe someone that's really involved in the social network or those sorts of things. But they're looking for people who can understand these financial statements, understand these stories, and approve or deny loans. So yeah, we both have a goal of serving on bank committees, likely far in the future, because it would make it challenging for us to lend from that bank if either of us served on that board. So we wouldn't want to serve on boards either in this exact local area or until we're kind of wrapping up our active part of our real estate investing.
They're usually looking for people who have a few more decades of experience.
A few
more decades.
Yeah. Our investors have tried to get us on loan committees of their local banks.
Yeah,
so that's been fun.
That's been a real treat.
So let's wrap up here with kind of our final story, and then we'll stay for a few more minutes to answer any questions. But let's talk about our first commercial loan. So if you're not looking at your slide, look at it. This house was rough. This was a $35,000 acquisition. The property had been vacant for 9 years before we acquired it. We did all new roof, new windows, landscaping, and then we did an interior renovation as well. So we have some of the afters here of the bathroom. We laid all that tile floor, painted it. That was back before we knew how to change light fixtures, so we didn't put in new ceiling fans, but we
hadn't figured out that skill yet.
We put in that deck door. So there was kind of a before picture there to give you some sense of how bad this property was. I think that was actually after we painted, because we painted it that
I
pale
think
yellow
so. Yeah,
color,
I think
but we
so.
hadn't done like our landscaping and everything yet. But then we, we made it look really nice inside, and we drove up the value through a lot of sweat equity. We paid for this property with cash. We did most of the renovations ourselves. We either, did them ourselves with the materials. The few things that we had to have a professional, like the roof, the HVAC, we paid for that on credit cards because we had actually run out of cash to complete the renovations.
We were all in, baby.
We were all in. We were working on this project. We were both working at the time, so we would work at this property until midnight, 1 a.m. This was before kids. And when we were done, we were really excited. We placed a renter in just a few days of it being on market. It was just such a joyful time. I mean, neighbors were coming over to meet us and telling us how happy they were that the boards were coming off of the windows, that the roof was being repaired. Just so excited to see this home come back to life. And then we knew that we had to harvest that equity because that was like the extent of our life savings.
That was
I mean,
everything.
it is, I think we had like $3,000 in the bank. Now we were way younger. We had far fewer responsibilities. We didn't have kids. So that was like a lot of money at that time, but that was, probably like a month of savings for us. So we needed to replenish our cash. Number one, to replenish our emergency fund, but number two, because we knew we didn't want this to be the end. We knew we wanted to keep investing. So we had to get lending. And we had never heard of commercial lending before. We had only ever heard of the mortgages that we had on our personal homes. So we both owned personal homes. We had some experience with that, and we didn't know what to do to get lending on this project.
So what is how would you figure out how to get lending on this? What would be the next step that you would take? We talked to the person who originated the conventional loans for us on our personal homes, and they're like, well, we really can't originate anything that's under 100,000. And this probably was maybe worth 90K or something like that at the time. And so we're like, oh no, this was our business model to get a loan. We didn't realize you couldn't get a conventional loan for less than 100K. So
oh man, I remember being so scared. I'm like, Nick, that was all of our money. So that house is not going to put food on the table.
So we went to our mentors. We went to people who were further down the path than us, and we just asked for referrals. We said, hey, come check out this property. We're really proud of it. By the way, we don't know how to get a loan on this thing. So what would you recommend? And one of our mentors just said, oh, you need to talk to this guy. His name was Jesse Cohen at Reliance Bank. And he said, yeah, he specializes in loans for properties under 100K. Like, this is the power of having a mentor, a coach, someone that's done what you are trying to do. We never in a million years would we have found this guy if we like sought out to find him on our own. But of course, our mentor, he owned like 100 properties that were worth less than 100K. So he had the best guy in all of Oklahoma, a million people in Oklahoma City, and he had the best guy. We called him, got it on a referral. So we're like, hey, is this Jesse? We got referred to you by Rodney. And he's like, oh, Rodney, is he helping you guys out? What did you do? And I'm like, oh no, we did this on our own. But he's like a mentor of ours. And he's like, okay.
I was their nanny.
Yeah.
Many moons ago.
Yeah. And he's like, okay, so Rodney knows the property. I'm like, he's visited it. And he's like, okay, so it's a good property. And I'm like, I think it's a fantastic, like, I had no idea what this conversation.
Have you seen that tile floor? My wife laid that by herself.
I was so lost in this conversation, but it's all about referral, because I'm sure he got off the phone with me and he called Rodney and just said, hey, Rodney, some kid who has no idea what he was talking about called me and asked for a loan. Is he good for it? And Rodney said, yep. And we got the loan. That's it. That's the power of referral right there. So I talked to the guy
like sitting in closing, and they were like, oh, this is a commercial loan. And I'm like, what's a commercial loan? And you were like looking at me. Nick and I are very good with our eyes. We spend a lot of time together. So Nick like looked at me and I'm like, oh. I should ask that question later. Probably someone else, a different banker. You all now know what a commercial loan is, and
I was just
how to get them.
Don't try to pretend to be something you're not. By the way, just be transparent, and people will be rooting for you to figure it out. I remember talking to him, and I'm like, okay, so do we get like an appraisal? And he's like, on an $85,000 house, why would you do that? Appraisal is like $500. That's like 1% of the value of your property. And I'm like, okay, so how do you know how much money to give us? And he's like, well, how much do you need? Like, what are we doing here? Like, well, here's how much we spent, so I'd like to get a little more than that. And he's like, okay, sounds good. And he went and looked at the property. He did a drive-by, and then he wrote us a loan like a couple weeks later. I remember vividly sitting there and holding that check in my hands, and sitting in my car, like I felt like we just robbed the bank, like we still owned the house. We had all of our cash out of it, that the loan was getting paid now, it was appreciating, it was cash flowing. And here was a check in my hands for more money than we put into that house. And we got it effortlessly with a commercial loan. I still didn't even understand how I got this check. It was like 1% of the work of getting a loan on my personal home. I never gave him a single piece of anything. He literally just called my mentor and said, do you vouch for him? And that was the extent of the underwriting. And I said, I said to myself out loud, I need to dedicate the remainder of my earning days to getting as many of these checks as I possibly can. And that's exactly what we've done.
Here we are today.
Yeah. Jesse Cohen.
Crazy days.
He believed in us. And then I said, okay, Jesse, you ready to do the next one? And he said, hell no. This is your first property. Like, why don't you run this thing profitably for a year and make some payments so we know you can actually make the payments, and then we'll talk about doing another deal.
He did refer us to another bank, though. He said, call my friend across the street.
We'll spread your risk out.
I'll tell him that I have your first deal. I can't take your second, but he can take your second. And then if something bad happens, we both only have a little bit of risk, but I believe in you. I can tell you guys have worked hard. So call him, tell him I sent you. And we had to repeat the process all over when we came to Rochester. You're just pounding the pavement, doing this credibility decks.
We did conventionals when we got to Rochester because we had a hard time. We didn't have that mentor that could vouch for us. And there's like a member on our team. We literally called one of our bankers. He's so young, he didn't have a tax return. And we're calling our banker.
He got his first investment property when he was like 18 years, 7 months or something.
I remember talking to our banker and we're like, hey, can you give him a loan? He's like, sure. He's one of your guys. He like works for you and he's good for it. I'm like, yep. He's like, okay, we'll have him send over, tax returns. I'm like, well, he's kind of young, so he doesn't have a tax return. He's like, Nick, is he really good for it? I'm like, oh yeah, he's a really sharp kid. He's going to be raised. Like, okay, sure. Yeah, we'll write him a loan. That's the extent of the underwriting process, So it's very much a referral business. And by the way, if he didn't make a payment, I'd be getting a call.
Yeah, absolutely.
Nick, what the hell?
I promise you, somewhere in their spreadsheet is like who made this connection. And yes, we would get a call of what happened here. How are you going to fix this?
And there would be some tacit obligation that I would step in and make it right.
Absolutely.
This is a relationship game. Yeah.
Jennifer asked a really important question that I really want to make sure we hit here. So she said, once you max out your 10 conventional loans on single family homes or small multis, is it worthwhile to seek out a small commercial loan for your next single family home? Let's say it's under 500,000, or does it have to be bigger than that? For example, does it have to be a property that otherwise wouldn't qualify for a conventional loan? Really excellent question, Jennifer. I'm glad you brought that up because yes, you can get commercial lending on single family homes, duplexes, triplexes, quads, $20 million apartment buildings, $100 million apartment buildings. So we personally have, I don't know, like 85 single family homes. And actually today, all of them have commercial lending because we've refinanced out of our conventional lending. But I would say, the average value of those homes, 250, maybe 300 today after the market has appreciated some. So what many might consider to be, a small property or a base hit, and they all have commercial loans on them. So I don't want you to think that, because we peppered in stories about large apartment deals or those sorts of things, that's the only time that you get commercial lending. If you have a single family home and you've maxed out your conventionals, or even just like Nick said, you're looking at your conventional options and you're like, man, that interest rate hurts. I want to see what I can do on the commercial side. You can do that for properties of any size. And we even just shared an example how commercial lending was the only way to get a loan on an asset because the asset value was so low. So very good question there. This is the ticket to scale, whether you are scaling from 0 to 1 or 5 to 6, or you're making big moves and doing 9-figure deals.
Yep.
Good question.
How do you contact the bank to inquire, take over the loan or bank note or note that is in default or pre-foreclosure? Great question. You just call and you say, hey, we are always looking. We specialize in turning around assets that are in a challenging situation. So if you ever have a bad asset on your books on a watch list, please give us a call, and there's a good chance we can put together a win-win deal that avoids a lot of hassle for a lot of people. And remember, the one way to lose your job at a bank is to write a loan that goes bad. So they're writing our name down like, okay, thankfully I don't have any bad loans on on my books right now, but if I do, I'm giving you a call. And then we just call back, once a quarter or something like that, and just remind them that we're always looking for assets that could need some saving, basically. So it's all relationship driven, and the bankers appreciate getting those calls. We call the bankers all the time when we don't need anything, just to celebrate how amazing an asset is doing that they have a loan on.
Oh yeah, those are fun calls.
Because then they can go report that back to the
like,
board.
hey, you want to come check out the renovation? I'm just going to send you the rent roll just cause. Or I had a meeting with our accountants and I just wanted to share this fun story with you. I had a meeting with the leasing team and wanted to share this win. Just little emails just to say, hey, you wrote a good loan and it's good for it, and the loan's secure and your job's secure, and let's go to lunch again. It's been a couple months.
And then when we go to them and say, 6 months later, hey, we're buying a deeply distressed asset with 50% rent collections. It needs $1 million in rehab. We're going to increase rents by 50%. Would you like to write a loan on that? They have 2 pieces of data that we specialize in buying distressed assets, and we are really freaking good at it. And we get a strong term sheet, like a stronger term sheet than sometimes people can even get on a stabilized asset, because we are constantly messaging to them with very sincere value. Do you have any bad loans you want to get off your books, because we specialize in buying distressed assets? And would you like to take a look at how awesome the stuff you've lent to us in the past is performing, so you can go brag to your boss about it? So constantly bring them real value, and then those are the things that are top of mind when we go back to them to ask for debt. It's no exaggeration to say that someone might be eligible for like a 50% LTV loan at an 8% interest rate. And when we ask the bank, exact same asset, we might get an 80 or 90% LTV loan at a 5% interest rate. So like a 30-40% spread in LTV and like a 3-point spread in rate. Well, that's the whole deal. That's the whole deal.
That is the deal.
Who cares how much you pay for the asset if you can get that big of a spread on the loan term? And as you move up the ladder and do bigger deals, it's tough to get a steep discount. Like you can buy a single family home for 50% of what it's worth. It's difficult to buy a commercial asset for 50%. Maybe you can buy it for 90 or 80% of what it's worth, but you can't get that steep discount on it. But you can get a steep discount on the loan. Yep.
Stacy asks an excellent question. The credit union that has been refinancing my houses has a hard requirement of not closing before 365 days after a purchase. It looks like you're not having that issue. Is that an institutional decision or maybe a state regulation? That's almost certainly an institutional decision. So for conventional loans, that's a national decision that conventional loans have to season.
It's a huge thing, by the way.
Yep, for 6 months. There is no such seasoning period required in commercial lending, but every bank is different. What we did is we went to banks proactively and said, hey, we are people who buy distressed single family homes, we renovate them, and we want to go as quickly as possible. And there's a narrow window to do good renovations in Rochester because of snow. So we need to have it all lined up so that we can buy a house in April, renovate it, get the cash out in May, buy a house, renovate it, get the cash out in June. We know that's a little bit crazy, but here are all the vendors we work with. We can take you to 2 or 3, renovated properties. We can show you some rent rolls. Does that sound exciting to you? Do you understand how we're generating so much value here? Let's approve it in advance. We'd like to get, 7 homes this year. So let's do like a $2 million line where the moment we're ready with renovation, as soon as we send it to our leasing team, we're also going to send it to you. You'll do a drive-by appraisal or maybe a desktop appraisal. We'll have that cash in our bank in a week or so. That took several years to make that happen. So maybe like listen to the recording again of what I said there, but that was the lending product that we created so that we could move very quickly. And we set the standard that we expect from the time we close until the time we get cash back is like 60 to 90 days, because we want to churn that cash as quickly as possible. And, I don't know, maybe a third of the banks that we worked with were willing to work with that. Others wanted to see, stable rents for 3 months, 4 months, 6 months. It's all a negotiation. And then as our portfolio got bigger, remember one of our slides was with commercial lending, it actually gets bigger. It actually gets easier as you get bigger. It actually gets easier as you scale. So we were able to say, well, tell you what, why don't we show you the renovations we did last summer? And you can see the rent roll, you can see the, the folks that moved in, they've stayed there. Heck, we even have some renewals at this point. Either people have stayed or, we've leased it to a new family. Why don't you look at that data to see how this set of properties is likely to perform, and let's build our proposal off of that. So it's all negotiation. My hunch from reading this is that credit unions tend to be more risk averse. Their charter is to provide for personal finances. It's not necessarily to help people with investing. And if it is to help people with investing, it's like small portfolios. Maybe a couple acquires, 3 homes over the course of their life, like their starter home, they move to the next home, the next home, the next home. Credit unions typically aren't doing a lot of large scale investment banking. So my guess is that's an institutional decision, and you should find another bank that is a little hungrier to move quickly, because I know you do, deep value add renovations. Yep. You want to churn that capital as quickly as possible.
Yep.
Lindy had asked, in your example, what's the advantage of refinancing to commercial loans? So I saw when that question came in, I think she's referring to how I said that on our portfolio, we have no conventional loans because we've refinanced out of them to commercial lending. So basically, starting at day 0, our very first one was a commercial loan because it was such a low asset value. But our second property was conventional, and then we hit that wall that we talked about in our first opening slides, and we had to move to commercial lending, and then commercial. But as time went on, those original houses had grown in value as the market has appreciated, and we wanted to harvest out that equity, but we couldn't refi into a conventional loan because at that point we had 20 houses. And so there's no way we would have gone through the algorithm. So technically I could have 10 conventional loans and Nick could have 10 conventional loans. That's the underwriting guidelines, is that a borrower can have 10. And if they're married, each borrower can have 10 for a total of 20. But there's no way we could get through the underwriting because our schedule of real estate owned is so large that we would break the algorithm. So we're essentially kind of never able to get conventional lending ever again, and we have to do commercial lending because we would break the algorithm. So that's why we have no conventional lending anymore. Even the loan on our personal home is kind of a quasi commercial loan. So it's a small local regional bank. We said, hey, we need a loan on our personal home. Obviously, it's not a commercial loan because it's not an investment property, but there's no way we're going to get through conventional underwriting. So will you give us a commercial loan that looks like, a personal loan? We want it to be 30-year fixed. We want, an owner occupant down payment, maybe regular appraisal, all of those things as though it were a conventional loan. But on your books, it has to be a commercial loan because there's no way we'll get through the algorithm. And they're like, yeah, local business owners, you own a bunch of real estate. That makes sense why you would need that lending product. So we have no conventional lending whatsoever.
And for pretty much everyone on this call, you are all better off getting a commercial loan than a conventional loan, just with where rates are right now. And that's particularly the case on a refi. So you're going to get penalized extra points in the algorithm on a conventional for doing a cash out refi, and then you get penalized extra points if it's an investment property, and then you get penalized extra points if it's a small multi. So you might be looking at, no joke, like an 11% interest rate if you did a cash out refi on a non-owner occupied small multifamily property, and then like a 5.5% interest rate on a commercial loan. It could be half of the interest rate on kind of a worst case scenario for the conventional and a best case scenario for the commercial. And you will still get a higher LTV on the commercial in addition to that. In addition to that, you might be at a 70% LTV on the conventional and like an 80% LTV on the commercial. So this is a big deal. This is historically unprecedented that you can get a better rate on a commercial than a conventional. And it's probably going to be this way for a very long time as the Fed unwinds mortgage-backed securities from its balance sheets. This is a sea change, and the investors that get the commercial stuff, they're gonna thrive, and the investors that relied on conventionals and don't understand commercial financing, they're just gonna say, oh, the numbers don't work, I need to sit out and wait for the crash, and that crash ain't coming. I'm sorry. So we don't want you sitting out all of 2023 and 2024.
Absolutely. Well, that is a wrap. We have a curfew at 10 o'clock to relieve our nanny. So I hope this was a good night for you. I hope that you took notes, you have a plan, you're able to advance your real estate investing journey, by decades in just a few days by implementing this plan. I will put some links in our Real Estate at Scale group tomorrow, our Facebook group. So join that if you're not already in that. I will also ask Rachel to include the links to those things in the replay email that goes out. If you know anyone that would benefit from being a part of our community hour, our newsletters, please send them our way. They can just meet blackswan.com. They can sign up for the newsletter, sign up for community hour. Referrals, are how we've grown our business. Most of the people that we work with are kind of 1 or 2 connections away from kind of that first group that we first met. So we're certainly appreciative of any referrals that you have. As I mentioned in the beginning, there's a couple of additional webinars for our Q4 update, our February community hour. So, come to those. We'd love to see you. There's a Black Swan event calendar that you can subscribe to so that all of the events just go on your calendar with the Zoom links and everything. I think that is everything. It is always a pleasure to serve you. Yes. I always just get so excited in the days leading up to community hour of like, what are we going to talk about? How are we going to teach? And how can we really move the needle for people? How can we take this knowledge that we've spent, over a decade bringing together and share it as quickly as possible with as many people as possible? So thank you so much for the privilege to spend the evening with you all. Have a great night.